Numbers, a $3 billion buyback, surely the headline there. Infineon in focus. This one could go higher, but actually there's a lot of positive FX in there. Do we just assume that that continues? Diageo withdrawing their medium-term guidance as a result of the looming tariff battle in North America. Will that come to pass, Guy?
Absolutely. All of that to be folded into the market this morning. You've got the macro and the micro to think about in terms of the opening trade. So let's show you some numbers, give you an idea of what is going on this Tuesday morning. FTSE 100, the commodities trade may have an impact on what we see out of London this morning. It may be something of an underperformer, despite not actually, on the face of it, the UK facing a tariff threat in the way that maybe the EU is. So the FTSE 100 flat to a little bit negative, down by circa 0.2%. The Stock 600 comes through up by 0.1%. We're not getting a clear sense of direction here at the moment. The IBEX is absolutely flat. You've got to think about the fact that that Mexico and Canada are no longer on the list, but China is. So kind of how do we balance this all out? Plus then fold in some of the corporate earnings. The CAC is now up by 0.2%. Be interesting to see how BNP Paribas factors into the thinking of that market. But broadly, we are just a little higher this morning, Anna.
Yes, just a little higher, up 0.1% on the Stock 600. The FTSE provides the downforce, but elsewhere we are seeing a bit of tentative positivity, still waiting for the Xetra DAX to open. In terms of the sector picture, we're getting some uplift from some earnings stories, but also some of the broader geopolitics perhaps. So basic resources, the best performing sector up by 1%, and that's pretty broad base. So despite the fact we see some commodity prices coming down, we've actually got basic resources moving higher. Banks is another sector in focus, and that is up by 0.9%. We've seen some corporate reporting in that space. BNP Paribas is up by 1.9% on the back of the numbers there. We also see a bit of a rebound in some of the banks that were sold off on trade tensions around Mexico yesterday. So some of the Spanish banks not doing too badly. I mentioned lower commodity prices. Actually, I was talking about oil there, and that does make sense of what we're seeing on the Stock 600, with energy names being the worst performing sector. That's down by 0.5% as BP drops by 1.4%, Shell down by 0.7%. Yeah. So there's a lot happening this morning.
UBS is up by 3%. On the back of its numbers this morning. The banks are delivering. You have UBS up by 3.3%. You have BNP Paribas in Paris up by 2.7%. Both banks are beat with strong trading numbers coming through. Both banks are delivering in terms of the returns they're delivering to shareholders. In some ways, the volatility we see adds some upside to these institutions. They are doing relatively well. And actually, it was interesting to hear Lars Machinel talking about actually a pivot point also around the retail bank story as well. So maybe a less negative story to tell there. So the banks are doing well. Coloplast is also out in the chemical sector. It is doing well as well. One of the three big gainers in terms of points added to the 600 this morning. BNP Paribas, UBS and Coloplast.
Yes, and we heard Lars Machinel saying they're aiming to service that volatility. There's volatility out there and they want to be making some money on the back of that. We still don't have an opening price, I think, for Infineon, and there is an expectation that that will be a strong performer today. So we'll keep an eye on the technology sector and take a deep dive into what exactly has been driving the Infineon story. And in fact, Infineon is open. It's up by 10% in this morning's trade. We'll get more, though, on what it is that has been driving the gains in Infineon, because there's a positive FX story. To what extent that continues, we'll see. Let's broaden the conversation for the moment, though. Joining us now is Anne Doe, Portfolio Manager at Julius Baer, and a great voice to add some sanity to all of the volatility that we're seeing in markets and some direction. Please add some direction for us. Because, you know, we feel like we get whiplash daily on the tariff narrative. Friday, we thought we were going to get Canadian and Mexican tariffs. We didn't get those yesterday. Today we get Chinese tariffs. So the world is evolving and our thinking evolves. How do you see through all of this fog of tariffs?
Yeah, good morning, Anna, and good morning, Guy. On the tariff question, I think it really emboldens our view of U.S. outperformance. We've talked about how U.S. stock market continue to outperform the rest, so it's U.S. versus the rest, not just Europe at this point. And the tariff question and the tariff debate sort of back and forth reinforce our conviction there.
That's interesting because, I mean, there were a lot of casualties yesterday in a market sense from the Trump tariff narrative. One of those was US stocks for a while, and there was a lot of expectation that, look, this is going to actually weigh on the US economy, push inflation higher and weigh on GDP. But you don't think that makes a difference to that US exceptionalism story?
So for a while, we've seen US outperformance on the upside. I think yesterday you've seen more painful points in Europe, for example, the Europe car makers, the Europe more cyclical sectors. I think in the US you have an abundance of long-term growth stories that can be somewhat insulated from these tariff noise. That said, yesterday you also see technology stocks in the US selling off. But to me, it's really a short-term phenomenon. It's a function of liquidity and positioning rather than any impairments to the fundamentals for these stocks.
What is the Trump trade? We thought the Trump trade was a kind of risk-on narrative. Is the Trump trade still a risk-on narrative?
Yes, the Trump trade, is it still risk-on? I think that's the events of the last 2 weeks have called that into question, right? I think at inauguration, people have maybe grown a bit complacent about tariff and policy risk. I think the market is more awake to that now. We're still to find out, but I think long dollar is quite consensus at this point.
Still, so the long dollar trade's still on?
Continues to work. We've added to gold in May, so with geopolitics going on in tariffs and also elsewhere in the world, gold continues to work. So we're holding on to that neutral position in equities and then adding to gold.
Is the dollar going to be a headwind at some point for US stocks?
To strengthen the dollar, I guess there is that potential for there to be currency effects for non-earners in the international markets. But I think overall, if you zoom out over the earnings potential for this year, the market is still expecting low to mid-teens growth for earnings for the S&P 500, for example. So I think that continues to underpin a strong market this year, as we expect for U.S. equities.
And do you see anything that changes the competitiveness conversation around Europe? And I mean, through the Biden administration, we talked lots about the IRA and the way that was encouraging investments in the United States and not necessarily seeing so much of that in Europe under a new regime. Does that get worse? That split get worse, or do we see something different?
Competitiveness, we've heard the good chatter outside of out of Europe. We've all seen the Draghi report. I guess there is an acknowledgement that there's something needs to be done. But that said, we think the story, but there's still some way to go until we see meaningful action and for that to play through to the Europe versus US competitiveness landscape.
And does that play into your thinking about Europe and where you invest in Europe?
In terms of Europe opportunities, it's quite idiosyncratic so far. It doesn't feel like it, but actually year to date, Europe has done quite well versus the US. I think it all comes down to pockets of strength. For example, in the luxury sector, you're seeing a bit of a bounce because there's that strength in the US consumer lifting the rest of their exposure. In semiconductor equipment, there is still that bounce in orders, bounce in that long-term opportunity for CapEx. So there are pockets of opportunities in Europe for quality companies, but we're not yet in a position to call a cyclical recovery for the broader Europe market yet.
Is this an environment in which you take less risk, though, in your portfolio? If you're a PM sitting there at the moment, is the instinct to take less risk, do you think? And do you think there is a broader effect that comes from that?
Risk positioning in this market is challenging. I mean, it's uncertain. The news flow can change from hour to hour, from morning to afternoon. At the moment, we are neutral equities, so that means we've taken some chips off the table, taken some risks off in late December, in early January. We're holding on to our money market funds position. We have more cash equivalents than usual in client portfolios, exactly in preparation for these.
Sorry, you're about to say, why would you do that? What is the objective there?
This has been our position going into this year. We're hoping to take advantage of volatilities, just like what's been playing out. That's why we're taking time to assess whether there's any damage to the long-term fundamentals for corporate earnings.
So dips, you still buy dips? So if you see a dip, you buy it?
We're still quite positive on risk assets in terms of our earnings growth potential for this year. We still think S&P could deliver high single-digit 10% this year. That said, we are monitoring whether the news still really changes that fundamental view for earnings this year.
Yeah, are there any other dips you buy other than sort of US stocks? Are there other things, other themes you're looking to add to? And if things are repriced, you jump in?
What's interesting under the hood in the US market is technology, right? Because you've seen software names really lagging in the AI trade. That said, this year we're seeing a massive catch-up in software versus hardware.
Yes, because NVIDIA dominated, and now there are questions about NVIDIA, and so software catches up.
Exactly, so software outpacing hardware. And if you take a step back, we've been questioning how are we ever going to monetize all the investment in AI, and the DeepSeek new and all the news around lower cost to serve, I think could end up to be a positive news for the long term for AI adoption, for that monetization, most likely through software.
Palantir last night painting a very positive picture about what it sees going forwards. And great to see you. Thank you very much indeed, Ando, portfolio manager at Julius Baer, joining us on the outlook for these markets. This is what the Core 6 looks like here in Europe. Clearly, we have a banking story that is dominant in some ways with BNP Paribas and UBS out with numbers not reflected necessarily here. Novo soft, Ferrari soft, Schneider soft, Nestle soft. The tech story in some ways comes back, hardware, ASML comes back, luxury absolutely flat right now. But the action is elsewhere in the chip space, you could argue, than ASML. Infineon front and centre, a big move, Joe Easton.
That is a big move, as you say, Guy. We've got Infineon up almost 12% now, coming back down to around 11%, but a big move in this stock. Now, remember, the company bucking the trend in terms of the semiconductor firms that have actually reported weak guidance. That was a note from Citi that I read. And also, as Anna pointed out earlier, there is, of course, the FX effect with the weaker euro benefiting the exporter there in Germany. So that is partly due to the euro effect on Infineon. But a big move out in terms of that. Then in the banking space, UBS edging up very high, $3 billion worth of buyback for the company. Of course, we did have BNP as well, announcing $1 billion of buyback themselves, but it does look like UBS is continuing the gains. They're only a small move higher now, up 0.2% for that one. In terms of Diageo, it's not getting any better for the maker of my favourite beer, well, pretty much everyone's favourite beer at the moment, Guinness. Diageo coming down. They've withdrawn their sales guidance once again. Not looking great for the company. That stock lost around a third of its value, as we showed earlier, on a 2-year basis. Then in terms of the healthcare space, Bavarian Nordic. Now, this is the company that made the Mpox vaccine and did quite well in terms of their sales, and a big rally for that stock recently. But coming down, it does look like there is some weakness on their sales, according to analysts. So that's a weak one today. And another weak one, which we don't see weak very often in terms of intraday moves, is Vodafone. Now, Vodafone reporting softness in Germany, according to analysts. The organic sales missed expectations. They've reported organic sales down around 6% in Germany for the quarter. It was expected to be down 5%. So that's the reason the UK company is declining today. I believe that was the worst on the FTSE 100. Vodafone down 4.8% in London this morning.
Thanks, Joe. Joe Easton from our equities team. A quick word about some of the other coverage that we're providing here at Bloomberg. Bloomberg's Jemana Besetcha is holding a fireside chat with the Turkish finance minister right now. That's from a Bloomberg Future of Finance event. It's taking place in Istanbul. If you want to keep across the Turkish story, you can watch that conversation in full on the terminal using the function Live Go. And we've heard from Simsek talking about the focus being on inflation, and in the short term, that might mean some downside risk to Turkish growth.
Let's turn our attention back to what is happening with the banks. UBS trading higher after a positive 2024 and $3 billion worth of new buybacks. We're going to take you to Zurich next. Francine Lacroix standing by after her conversation with Sergio Motti to update us. That's next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
We are well prepared in terms of what it means for us in terms of risk management or capital management. That's the reason why we run a balance sheet for all seasons. But eventually, a bank is potentially going to be affected by second-order effects. What does it mean to the economy, and in turn, what it means to our clients? And therefore, no matter if they are wealth management clients or they are corporate clients, there is a second-order effect on us. And what we need to do is to stay close to clients and help them to navigate this challenging environment.
Challenging environment. We're certainly seeing some volatility in the stock this morning. UBS gapped higher at the get-go and is now falling. And in reality, as you can see on the screen in front of you, is now down in negative territory. On the face of it, this looks like a beat and a boost to the share buyback. Francine, talking to Sergio Amotti there, joining us now. Francine, generally, this looks like a good set of numbers. The surprise seems to be coming through maybe in the repatriation story, the return of capital story. Did he address that?
Well, I have to say the surprise is really that the share price started 3% higher, and now it's down by 1% without any real catalyst. So, you know, when you look at the numbers, it seems like it's a solid set of results. Of course, there's still this overhang of the capital requirements. Now, I did try and press him and say, like, look, does he get any news out of Swiss authorities, out of FINMA, of what they plan to do with it? Remember, this started about a year ago, where the talk was, look, if they have to repatriate money to pay us for capital requirements, this would be extremely expensive. He just doesn't get drawn on it. He says, look, we'll see. There's, you know, ongoing discussions. One thing I tried to try and understand from him is whether he thought regulators in Switzerland would soften because of what's expected to happen in the US, which is deregulation, clearly giving Wall Street advantage. And again, Sergio Amotti really being very tight-lipped, saying, like, look, we'll have to see. For the moment, he doesn't know. But it doesn't really explain the share price movement that we've had over the last 10 minutes.
Yes, so something happening there. In terms, Francine, good morning. In terms of the outlook for the rest of the year, within the sector, there's optimism about maybe what the US economy might look like. On the other hand, nervousness around tariff controls and where that takes us. What is he expecting in terms of market volatility?
Well, he is expecting market volatility, and he was very clear in saying, look, when you look at the last couple of weeks, there was a lot of surprises. We talked about AI and DeepSeek. He also said, if you look at some of the markets, they're clearly, if not priced to perfection, they could be due for a correction on certain metrics. If you look at what this means for a big bank like UBS, I mean, if you're on the right side of a trade, it's not bad at all. If you're a wealth management and there's a lot of volatility, and again, you can service your clients, it means that fees won't be slammed as much. So he doesn't necessarily see it as a bad thing, but it's another headwind to think about, especially if it impacts inflation, therefore interest rates, and that has an impact on their net interest income. But overall, look, today was okay in terms of the outlook. He says there's nothing to really be worried about. Of course, they're still going through this integration process of Credit Suisse. They're about 6 months ahead of time, but he says watch out over the next couple of months as they migrate some of the clients, and so that's IT and quite a delicate phase, I would say, in the integration of Credit Suisse within UBS.
Where does the growth come from next? Does Trump and what he is delivering encourage Amoti to think about maybe expanding more in the United States? Geographically, how is he thinking about it?
So I asked him straight, look, do you want to acquire anything in the U.S. given deregulation? Again, we've caught up with Sergio Amati many times over the last month or so, and he's always looking at Wall Street saying, well, this is where the growth is going to happen. This is where they get deregulated. But he says, look, at the moment, there's still, because of the integration of Credit Suisse, there's still a lot to be done at home. But he certainly didn't rule out growth and even, the possibility of getting bigger through acquisitions in the U.S. But this is clearly, he says, for another phase, not in the current phase or now. There's still quite a lot to do to absorb Credit Suisse.
Francine, thank you. Francine Lacroix, of course, on the road in Zurich, talking to Sergio Amati and bringing us that UBS story. Let's move to another corporate earnings story that certainly has had a big market reaction. Infineon shares substantially higher this morning, up by 10.4%. I spoke to the Infineon CFO, Sven Schneider, and asked him about the state of the sector.
We continue to expect this, we call it gradual or modest recovery, not a big upswing, but a modest recovery in the second half of 25. And why is that? To your question, there are strong growth buckets. One is AI. The other one is still the electrification of cars, for example, in China. And the third one is that the first 6 months are heavily impacted by the inventory correction of many of our customers, be it on the automotive or on the industrial side. And we expect that inventory correction to phase out in the next months. And that is the core assumption for our yearly forecast.
Okay, so that's the forecast and what they're based on. Can I also ask you about tariff impact? We're talking now, Sven, just moments after hearing that tariffs have gone on to China from the United States, and then China has retaliated with its own tariffs. You do business in China. We're also thinking about the possibility of tariffs from the US into Europe. How concerned are you about the tariff impact on your business?
Yeah, so to be very clear here, a major escalation of the tariffs is not included in our guidance. Because we still are not giving up in advocating for free trade. We do not see that as positive for the industry. So an escalation of tariffs and counter tariffs would be negative. But I also can explain to you that if you look at Infineon, if you think about us in terms of the sales footprint, but also in terms of the manufacturing footprint, we are globally diversified. And of course, we are used in a semiconductor industry to work with these situations, but the speed and the intensity, when I woke up, I learned that Canada and Mexico seem to be pushed out by at least a month. That has increased, and of course, we are watching that very closely in order to analyze the implications and then to draw the right conclusions.
You're diversified in lots of ways, Sven, but the business is still very reliant on the car sector, and that could be an industry that faces more tariffs. Are you making any base assumptions about tariffs at this point? You said that no major escalation in tariffs is included in your numbers, but have you made any adjustments on that front?
Yeah, so indeed, the automotive industry represents, give or take, half of our business, so that's very relevant. But here again, to my point, it is a global market, but it's also a regional footprint in terms of manufacturing and sales. So we have manufacturing in Europe, we have manufacturing in Asia, we have manufacturing in North America, and this will help us to mitigate certain effects. So smaller tariffs are included, but as I said, no major escalations. That would require further analysis.
Okay, so smaller tariffs are included, but not any major escalation. Can I ask you about European competitiveness, Sven? Because you talked there about the different geographies that you operate in, so you're very well placed to talk about Europe's competitiveness. You've benefited most recently from a drop in the euro. That perhaps helps a little bit, but what other suggestions, as Europe thinks about how to make itself more competitive, what other suggestions would you have?
Yeah, indeed, the currency, as you said, is a tailwind, but I would not count on the currency because that can always go into different directions. I would say that what we are expecting the most, and there is a broad consensus on that topic, is that we have more political regulatory stability. On the one hand, and we are welcoming very much the very recent announcements from the EU, we need to look at some overarching regulation which has been announced in the past and bring it down and scale it down to levels which are adequate, for example, also for investors.
That was Sven Schneider, the CFO of Infineon, speaking to me earlier on. And really interesting, the stock is doing really well, Guy. They upgraded their guidance. But he said in that conversation, only half of that increase is to do with the underlying business. Half of that is an FX tailwind. And even he said, I wouldn't count on the FX. Now, a lot of people are talking about whether the euro goes to parity, and that would boost that business. They gave some quite sort of big numbers as to how much a weaker euro really does boost their
Does the opposite then work for US companies? You think about the kind of the tailwind of a weaker euro, maybe for Infineon. Think about what is happening over in the States and the maybe headwind that the dollar is creating there. Infineon is the only chip maker exposed to the auto sector that has raised guidance in this earnings season, according to Jeffrey. So it does stand out from the pack a little bit as well.
Yes.
Is that because of the FX? Is that because of something else? Is it just better at managing inventory than maybe its peer group?
He was talking about this sort of a positive view of the second half of the year, and that, to your point, does seem to be a bit of a standout performance. They had this same view in November, and going into these numbers, a lot of people were saying, did you get too positive too prematurely? And actually, can you still... But they're sticking to that November guidance, saying, yes, we do see something, a gradual upswing in the second half of 2025. And of course, AI is a real positive, and it's something that is increasingly coming through in the numbers.
But they have... It's the exposure to the auto sector that's just a great unknown.
Yeah.
How do tariffs affect that? How will what is happening in Mexico affect that? The volatility around all of this, really difficult to navigate.
And if you see the Chinese trying to use more of their own domestically made chips, if they go up the scale in terms of producing their own chips, and then that becomes difficult for the Europeans.
Diageo this morning has withdrawn guidance. Here is a company that again is exposed to those same sort of buffeting that we're getting from the Trump tariff story. It has withdrawn guidance. Infineon, interestingly enough, sticking with its, and in some ways managing the inventory story maybe fairly well compared with its peers. Coming up, what would a prolonged trade war with China mean for the American economy? We are going to ask Aditya Bave, senior US economist at Bank of America Global Research, who is in London this week and joins us next. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Welcome back. This is the opening trade. 30 minutes into today's session, and things taking a turn for the worst, it would seem, across European stocks. So we're now down by 0.5%. This is all happening pretty quickly, escalating pretty fast. We had seen a bit of a turnaround at the start of the trading day. That's not endured. Technology providing some upside. That's the Infineon trade. But to the downside, we see the auto sector, which of course is a big customer of Infineon. So we'll see how long that lasts for. But things deteriorating a little bit, Guy. It
does seem so. It was interesting to see how quickly UBS in particular turned around. We're certainly getting used to volatility. Yesterday was certainly a session that delivered plenty of it. The Canadian dollar, the Mexican peso rebounding against the US dollar as leaders from the two countries said they've managed to strike deals with Donald Trump and that tariffs were therefore to be paused. President Trump laid out his reasons for the pause on the levies, particularly when it came to Mexican goods.
They've agreed to put in 10,000 soldiers permanently, like forever, 10,000 soldiers at their side of the border and stop fentanyl and illegal aliens from coming into our country. They have a big incentive to do. Other than that, we've agreed to talk and consider various other things. We haven't agreed on tariffs yet, and maybe we will, maybe we won't.
Senior U.S. economist at Bank of America Global Research, joining us around the table this morning. Nice to see you in London.
Good morning. Thank you for having me.
We have lots to talk about. So let's dig in first of all to the tariff story. It's not going to happen with Canada. It's not going to happen with Mexico. But the threat still exists. You'd highlighted the fact that you didn't think actually that the Mexican-Canadian tariffs would be long-lasting, even if they did come into force.
Yep.
But what effect does the uncertainty have in terms of how the economy evolves from here?
Right, so there's definitely a risk here that the uncertainty could weigh on business investment. Business investment was obviously a little bit soft in the fourth quarter as well. So that's something that we'll be keeping an eye on for sure. But when things are moving around so fast, I think it's really important to have a framework to anchor your views. And our framework has consistently been that Canada and Mexico will avoid sustained tariffs. As it turned out, we didn't get tariffs at all, at least for now. And the reason for that is two things. The first would be that Canada and Mexico are very incentivized to work with the U.S. to find solutions. And the second is that tariffs against Canada and Mexico would also be quite disruptive for U.S. manufacturing.
Can the same be applied to China?
Less so. Less so. With China, we think it's a very different story. It's really, you can think of the trade war within the context of kind of a broader geopolitical issue that's much harder to resolve. So the 10% tariffs against China are much more likely to remain in place, partly or quite substantially. And the other point I would make that I think is quite important is that 10% is calibrated. 25% is a big number that makes it less likely to be sustained, right? Whereas 10% is something that you could potentially sustain, and the removal of the de minimis exemption is also quite important.
Aditi, good morning. Let me ask you about what this does to the US economy in a bit more detail then, because I was reading some research by Bloomberg Economics, talked about the average US tariff. If we'd had all of these tariffs going on, they estimated that would go up from 3 to 10%, 10.7% or so. And now they say with the China tariffs going on, that goes from 3% to 4.2%. So it's an increase, but not a huge increase on the average tariff on things going into the United States. So what kind of impact is that going to have on the US economy?
Right, so I agree. When you take Canada and Mexico out of the picture, the numbers become much smaller. So we expect a small impact on the economy. I mean, you can start with the total tariff rate, and you can say, okay, there's a bit of an offset from FX, there's potential exclusions, and the rest of it is essentially either absorbed in margins or absorbed by the US consumer, right? And we think of it as about 1/10 on the core PCE, 0.1%, and maybe up to 0.1% or even less than that on growth.
So this is that's not huge, I suppose. So I guess that goes towards your argument that this could therefore stay on for quite a long time if it's serving a geopolitical purpose.
Exactly. The concern here that maybe makes it a little bit different from 2018, 2019 is that we're in a very different environment in terms of inflation. There's probably more willingness to pass costs on. And also this time, at least for now, the tariffs have also been applied to consumer goods. So think electronics. Think of all the stuff that we buy online, right? A lot of that was not subject to tariffs in the first Trump administration, and for now at least it is subject to tariffs.
I think Trump can deliver tax cuts if he doesn't do tariffs.
We do think that the Tax Cut and Jobs Act will be extended.
Right.
Beyond that, we expect some further cuts, right? So you could, for example, get full expensing of CapEx extended.
Was it ever realistic that tariffs were going to be able to, that there was some sort of balance here between tariffs coming on and tax cuts being therefore more achievable? Is that a line that you, as an economist, that you look at the US economy can actually draw?
The math is somewhat challenging on that.
That's a very polite way of putting it.
The way I would think about that is that there's other reasons that the deficit keeps increasing, right? Interest costs are going up. The population is aging, so you're spending more on entitlements as well. And with tariffs, the reason the math is difficult is that there are incentives to kind of reroute supply chains or rejigger supply chains in order to reduce the tariff burden. So I wouldn't think of tariffs as a reliable source of revenues in the long run.
What's the immigration policy effect that you're thinking about here, Aditi? Because I was looking at some analysis by one bank that talked about the number of jobs created last year through immigration, through new labour coming into the market via that route. What assumptions do we therefore make based on Trump's stated policies?
That's a great question. Our base case is that the flows of migrants across the southern border are going to slow further, but they've already slowed quite meaningfully over the last several months, right? So in that sense, the delta might not be huge. And then we'll just have to wait and see in terms of actual deportations, right? Whether the numbers turn out to be quite large or whether there's a focus somewhat narrowly on people with criminal records.
Yes, a lot of headlines generated, but maybe less economic impact in that case.
Potentially, although, you know, there's all these intersectional effects that you need to watch out for. For example, there's certain sectors that will be impacted a lot more than others. So think construction, think leisure. And then with construction, you think about, okay, well, there's going to be this demand for construction spending in LA, right? So is there going to be a labor shortage there? That's something we'll be watching for.
Should Powell just sit on his hands? You just laid out so much uncertainty. Should the Fed just sit, wait, watch, try and figure it out, understand what the implications are going to be?
That's been our view, and we've been out of consensus on this. So we, after the December jobs report, said the Fed is done cutting. And the reason for that was, one, they were cutting because they were worried about the labor market, but the labor market has now stabilized, and two, inflation stuck above target, and then all the risks to inflation are to the upside, right? So
if they're done cutting, is the next move a hike?
Potentially. I think there's some room to there's some leeway before they right. So 3% core PCE. I would say, is when you start getting worried about a hike. But if that's just because of tariffs, then maybe you're able to look through it as long as long-term inflation expectations remain anchored.
But the Fed is done implies there are no more cuts. So logically, you would assume the next move is a hike.
There are no more cuts in the near term. Maybe there are.
In this
What's the near
cycle,
term?
yeah.
Well, our forecasts go out to 2026. Obviously, by mid-2026, you'll have a new Fed chair. Yeah. And at that point, we might have to reassess things. But for now, for this year, we feel conviction that there won't be cuts, potentially next year as well.
That's a huge pause for the Fed. Is there any kind of historical precedent? That is a hugely elongated period for the Fed to be on hold.
So on average, when they stop cutting, they can be on hold for 6 to about 13, 18 months.
Right.
So it wouldn't be completely without
A
precedent.
complete outlier, but it's stretching the kind of boundaries of what we normally would see.
Yes.
It's going to be interesting to watch.
It is.
Aditya Bave, thank you very much indeed for updating us, Senior US Economist at the Bank of America Global Research. What have we got coming up?
Coming up, we'll focus back on the German economy. German industry was already dealing with economic growth challenges before the threat of Trump tariffs added to the list of headwinds for the business sector. We will cross to the port city of Hamburg and hear from the CEO of the Hamburg Chamber of Commerce next. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
up-to-the-minute global financial news whenever and wherever it happens. I'm Jonathan Ferro.
And I'm Lisa Abramowitz in Davos, Switzerland, and this is Bloomberg.
Welcome back to the opening trade. 42 minutes into a European session that seems to be losing momentum a little. US futures now down by 0.3%. Technology, the only sector that's moving higher, and that's the Infineon story, getting a positive response there. UBS, the worst performer in the financial services sector, and that's because it seems a lot of the positives were already priced in, Guy, but concerns around capital requirement rules weighing on that particular stock.
Yeah, the only lines I've seen that I can kind of logically work my way through are it had a great run into earnings. There's a bit of profit taking. People are taking a few chips off the table after what has been a decent run. It's going to be interesting to see how the US deals with the China story. It does seem maybe as if that feels, as we were just hearing from Aditya, maybe is a more sustainable impact. And while it may not be as dramatic as the 25% tariffs, it's only 10%. If it is more sustainable and more concrete, it therefore does have an effect, albeit maybe a little bit smaller. So maybe that's what we're beginning to think about as we start to approach maybe what is happening with the US session a little bit later on. The trade war story is pretty much everywhere you look at the moment. The European Union certainly bracing for a possible trade war with Washington. This after Donald Trump's recent threats to hit the bloc with tariffs. EU leaders, including Germany's Olaf Scholz, have vowed to retaliate. Bloomberg's Oliver Crook takes a look at the impact tariffs could have on Europe's economy, in particular, what they would do to Germany with an election just a few weeks away.
To me, the most beautiful word in the dictionary is tariff, and it's my favorite word.
As the United States and the EU square up to what could be the next front in Trump's trade war, at risk is the biggest and most integrated bilateral trade and investment relationship in the world. There's no free trade agreement between them, but operating under WTO rules, they enjoy some of the lowest tariff rates anywhere, at about 3%. The EU and the US trade about 850 billion euros worth of goods, with Europe running a surplus of about 155 billion. Meanwhile, trade and services was worth almost 700 billion, where the US runs a surplus of about 100. Combined, the exchange of goods and services was bigger than almost every single European economy on its own, at least for now.
And remember, again, the word tariff. We're going to protect our people and our businesses, and we're going to protect our country with tariffs.
According to Goldman Sachs, a 10% minimum tariff would reduce EU exports by about 150 billion euros every year, shaving off about 1% of European GDP. And Germany would pay the highest price. Germany's effort to de-risk from China has meant the trade relationship with the United States is more important than ever, and new tariffs by Donald Trump could cost Germany 15% of its biggest export market.
So the impact of tariffs, Germany and the rest of Europe waits to hear what the US has in store. Let's go to Bloomberg's Oliver Crook, who you heard reporting there. He joins us now from Hamburg. Oliver, what takes you there with the election under 3 weeks away? Of course, trade very much on our minds.
Yeah, that's right. I mean, Anna, we talk about trade and often very much as sort of into the abstract, but when we think about the German economy and what has been the sort of really great wealth driver for the German economy for the last several decades, it's really been a sort of system of globalization and trade. It has been a system that has brought a huge amount of wealth to the people of Germany. And when we think about it in the abstract. We think about billions of dollars. We think about tariffs of 20%, this, that, and the other. But behind all of that, like you can see behind me, is you have a very complex international system of trade where these goods actually move. And we speak to the people who have been building these from the ground up for many, many decades. And we have the opportunity to speak to some of them right here. The CEO of the Hamburg Chambers of Commerce, he's Malte Heine. He is looking after the sort of interests of the business groups around here. This is the oldest Chamber of Commerce in Germany, established in 1665. You look after the interests of 180,000 businesses around Hamburg. I'd like to begin, before we get into the sort of trade war and all of these sort of narratives, for you to sort of situate us in this harbor here and its importance to Germany.
Right, this is, we are here directly in the heart of Hamburg. The Hamburg port is the platform for the whole business community. It stands for 9 million containers turnover, and it's, 2/3 of German overseas trade is running via Hamburg port, making also the largest industrial compound area in Europe, and lots of heavy industries here. So our economic powerhouse.
So it's really fundamental. So when you have 48 hours like we just had out of the United States, where you had 25% tariffs here and there, and then they're gone for 30 days, and you have 10% with China, what does that make you feel? And what does that make these sort of companies that you represent feel? How sensitive, how vulnerable?
we have lots of concerns about that. It doesn't really surprise us because Trump is doing what he told on his election campaign. But for us, it's the foreign trade hub of Germany. It's a terrible situation, and the outlook is quite pessimistic that we are facing, because that will even put more pressure on German economy now.
And if you were to get 10% tariffs on the EU, as this is sort of what is being discussed, I know that maybe you'll be able to negotiate it away. What kind of impact do you think that would have on this harbor, on the sort of German economy and surrounding area?
So it's hard to actually calculate what is the impact. It's going to be a bad impact, and also we put other tariffs from the European Union. This is all we need, more free trade as a destination. But to see our economy in Germany is lacking of competitiveness in international regards. Yeah? So we have too much bureaucracy, and energy prices are too high, and all things like this. Tariffs making exporting goods more expensive. So we need to reduce anything and to train our competitiveness. Yeah?
And in terms of that competitiveness, I mean, you're also building trade relationships with China, with India. What do they want to see here, and what makes Hamburg and what makes it Portland an attractive place to come? What are the features that you're trying to sort of advertise to attract them here?
German economy is always dependent on international trade, and this is the gateway to the world that we have now, and we are seeking for new markets. As the port, we are very, very dependent on China. 1/3 of our container turnover has something to do with China, but we are now developing new markets, like in India, like in Vietnam, Southeast Asia, but also Latin America. The EU-Mercosur agreement is very important to our economy.
Have you had contact with a lot of sort of companies? Have you had sort of delegations go to South America and discuss with
lots of interest there? Also in building energy partnerships, like getting the green hydrogen from Latin America, from Chile, Argentina to Germany. That we are
How big do you anticipate that's going to be? Because I keep hearing people talk about green hydrogen. I still don't see kind of the economic sort of viability behind this technology yet. Is this something that's going to be a real driver?
Yeah, definitely. It's going to be a real driver, because we are already building the infrastructure in our port, the import infrastructure, and we have the industry companies from manufacturing sites. They are also practicing hydrogen as energy supply in their processes.
And of course, one of the sort of big issues that we're going to be paying very close attention to, and you are, of course, is a few weeks away. You have this election here in Germany. Right. What does the Port of Hamburg need? What do the companies you represent need from the next German government?
We need something like economy first, business first, and we need to do anything from the political perspective to increase our competitiveness. It's like anything talk about the sick man of Europe as the German economy. I have another opinion, because we are the lazy man of Europe sitting on the couch, and we need to stand up and do our exercises. So reducing economy, investing in infrastructure, and working more and harder to increase competitiveness.
But when you see the sort of political landscape and what's going on in Germany right now, at number 2, and some polls say there's only a 6-point difference between the CDU and the AfD. Right. The AfD is a party that wants to withdraw Germany from the European Union. Yes. It's not a very global-facing business. It's really the antithesis of what we have here. How much does that concern you?
Yeah, definitely a lot, because we are so dependent on international trade. On the European Union is so important to the business community, so we need to stay in here. And also we need to security issues. Pulling back from the NATO is also very bad perspective for the business community. We need to be an open society. We have a lack of skilled working force, so we need more migration into the labor market again from skilled people.
And we think again of the long history of the chambers of commerce. Hundreds and hundreds of years. When you see what's happening now, not just with the United States, but more broadly, it seems like there's a sort of ebb. You had globalization reach its high level, now coming down and feeling this deglobalization. Do you think that trend will stop, or how do you see the future of that?
I think merchants will always seek for new markets, and we have a long tradition in international trade, as you mentioned. And I think I have so many companies that are also looking for where to get new materials, where to export their goods. So I think there will always be globalization, but it's going to be hard. Any tariffs, any trade wars that we are facing is not a good development. So we need more free trade agreements.
And just before we go, I'd like to hear something optimistic about the German economy. What do you have to be optimistic about?
also optimistic because, you know, we have it in our own hands. It's more regulation. Politicians can invest more in infrastructure. We need to accelerate our infrastructure planning rights, which is also possible. So it's a mechanism that we need to implement to increase our competitiveness, and that's possible.
Well, Malte Heine, thank you so much. That was the CEO of the Chambers of Commerce here in Hamburg, who says that Germany really needs to be less lazy, needs to get off the couch and really get its act together and moving into this election.
Yeah, not maybe the sick man of Europe, just the slightly under-exercised man of Europe. Maybe that is the way of putting it. Lazy. I wouldn't quite go that far or be brave enough to do so. But nevertheless, it's interesting to see that actually it's about economic fitness now. You do wonder if you could ultimately see Europe benefiting from Trump by basically just being given a kickstart. You can catch the interviews from Ollie all throughout the morning. Ollie Crook live from the Port of Hamburg. Special coverage also on how the new German Chancellor may navigate the trade and tariff challenge. All of that starting 9:30 a.m. UK time.
Now, the pound is emerging as an unlikely haven, to some degree, for now. The UK avoids Donald Trump's tariffs, so can it continue? Prime Minister Keir Starmer spoke at NATO headquarters in Brussels, where he's been seeking to reset relations with Europe.
Days. And I think what's really important is open and strong trading relations. And that's been the basis of my discussions with President Trump. And I know that intense US-EU discussions are planned.
Our UK correspondent Lizzie Burden joins us now from Brussels. I mean, the extent to which the pound is acting as a haven, very limited, Lizzie. But can Starmer court both the US and Europe at the same time? That seems to be what has fallen to him as quite a difficult challenge recently.
Indeed, and it was a really interesting moment for Keir Starmer to be at NATO HQ in Brussels, given, first of all, the question of whether Trump's tariff threats on Canada really threaten the NATO alliance itself, and secondly, as you say, whether Starmer is going to have to pick between the US and the EU if Trump eventually forces him to. Starmer says that he's talking to both sides. Mark Rutte, the NATO Secretary General, says there are always issues between allies, but Anna, quite frankly, these are more than issues, and you have to wonder how long Trump will let Starmer sit on the fence here. Trump has suggested that the UK can escape his tariffs because US-UK trade may be out of line, but Trump says that one can be worked out. You have to see that the more Starmer aligns with Europe, the less room he has to accommodate Trump's demands on trade. And what's for sure is the UK cannot afford to have a trade war with the US, and no one knows that more than Keir Starmer. The risk is that Starmer offends both sides, but then there's also the point on defence. Starmer echoed Rutte's message of, to prevent war, you have to spend more. That is falling on many deaf ears here because he hasn't set a deadline for when he'll spend 2.5% of GDP on defence. Some of the French officials are calling him the demandeur.
Okay, we'll watch to see whether any demands from the United States around a trading relationship, whether they threaten what is in place to a limited degree with Europe. Lizzie, thank you very much. Bloomberg's Lizzie Burden in Brussels for us. Guy, taking a step back then, looking at the broader market story, it has weakened, hasn't it? The IBEX, with the Spanish banks recovering, actually in positive territory, but all other European markets are down.
So in terms of where the damage is being done this morning, Novo is soft. It's down by 1.5%. So Novo Nordisk is certainly taking a hit this morning. UBS is the next biggest hit in terms of the points. An hour ago, when we started trading, this stock was very much, it gapped higher. It's rolled over really aggressively. It's gone from the top to the bottom. I know they're in slightly different sectors, but BNP Paribas is the second biggest points gainer. So BNP Paribas is still doing well, up by 2.5. UBS is now down by 3.6.
We've had some interesting response to the trade tariffs through the lens of the corporates as well, with the likes of Diageo removing its medium-term guidance, and that stock down 4% as a result of just, huge amounts of uncertainty about what that business looks like if tariffs come back into the conversation in North America. That is it for the opening trade. Markets are a little negative this morning. The Pulse is up next. This is Bloomberg.
on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Zurich, and these are your top stories. China hits back at Donald Trump's opening trade war tariffs by targeting a handful of American companies and slapping levies on some U.S. goods. UBS says it aims to back up to $3 billion of its own shares this year, but shares reverse initial gains. Well, our interview with the chief executive, Sergio Armati, coming up. Plus, later this hour, we're live from Hamburg as we explore what a new trade war can actually mean for Europe's biggest economy weeks before the German election. Now, there is quite a lot of going on in the markets. We also had a good conversation with Sergio Armati about some of the volatility that we saw over the past couple of days, if not weeks. Now, stocks actually are pretty steady now after the to and growing from the U.S. tariffs. Again, U.S. stock futures pretty much steady. The dollar weakening a touch. Investors speculating that China's restraints, really in retaliatory tariffs, may actually help avoid this worst-case scenario in the emerging trade war. I'm looking at S&P futures. They're down some 0.2%. Again, it was just yesterday when the president granted Canada and Mexico this last-minute reprieve from a 25% tariff following leader talks. Now, some of the other things we're watching out for, let's look at dollar, but also treasuries. I'm looking at some of the other things that we need to keep an eye on. Now, again, because China seems to be carefully calibrating their response to avoid major blowback in China's economy, I'd also probably look at yuan. Gold, 2,815, euro dollar 103.37. So China has retaliated against U.S. tariffs, which came into effect this morning, kicking off a trade war, while Beijing is imposing 15% levies on U.S. energy imports and a 10% tariff on American oil and agricultural equipment. Now, China is also launching an antitrust investigation into Google. Chinese stocks traded in Hong Kong rebounded on the news. Joining us now is Bloomberg's EMEA News Director, Rosalind Matheson. Rosalind, when you look actually at some of what China could have done, are they really holding back? So it's a bit of a tit for tat, but they don't want this to escalate.
Well, it's very reminiscent to some extent of what we saw in the first Trump administration. So what you have is an announcement by the US, a calibrated response by China, and then we also saw China take action and the US take a fairly calibrated response. The idea is to send a message without tipping things far into escalatory territory. So what we see is really a kind of a targeted response by China. Obviously, LNG is significant, but China doesn't really import a lot of coal from the US. You cannot access Google in China at the moment. So it's about sending a message to Donald Trump that Xi Jinping wants to come into any conversation, perhaps even later today, from a relative position of strength, but he doesn't want to put things into a position where neither side can back down. And it's also about Xi Jinping sending a message domestically to the people of China that I am actually standing up for China here in a certain way. And it's probably about that messaging that's more important. And it's also about China really trying to pivot their economy bit by bit to a more of a consumption model. And that's what we're seeing in the announcements from state media and from officials in recent months. So it all fits that picture. And that's why you're seeing markets not react massively to this latest development. Of course, this is the imposition of tariffs on either side. That's not what happened, obviously, with Canada and Mexico, but it does seem to be a fairly careful response so far.
Roz, what did the last 72 hours actually teach us? Again, there's always a way of negotiating with Donald Trump. I know a lot of the headlines are saying, you know, from the tariff guy, he's now a transaction guy. Is it really that simple?
Well, it's a bit hard to say because obviously, you know, Trump is someone who reacts quite quickly in the moment. Perhaps he feels something about an issue and he just responds very quickly. He likes to talk a lot, so he'll announce tariffs on Colombia and then say he's not going to put them on a few hours later. So he's very instinctive in that regard, but he is also a negotiator and a businessman, and he wants something in return. The tricky thing here to ascertain is how do you come at him? Does he respect you? If you come at him from a position of strength, that's what we've seen China try and do. I mean, it was interesting to see Mexico went very quiet. They didn't announce any retaliation when Donald Trump said he was going to put tariffs on. And then, of course, there was an agreement to defer. So that's been temporarily paused. Canada immediately announced retaliation, and yet they still also got a pause in the end. So it's really about the personalities involved. Can you have that conversation with Donald Trump directly on the phone? Can you reach him yourself? And how can that conversation go? But it seems to be you can either come at it either way, and we'll have to see which one is more successful in the long run.
Roz, how far away are we from EU tariffs? I mean, given the speed at which everything's happened in the last 2 weeks, could we expect something this week, or we just don't know?
We really don't know. I mean, we also see that for now, at least, Donald Trump seems to indicate he's given the UK a pass. But for the UK, that could be a temporary reprieve. I mean, Brexit, maybe that's the one upside that we can see from Brexit, is that it does separate the UK from the EU a bit. But equally, that puts Keir Starmer in an awkward position because he's trying to re-engage the EU, including on trade. So that's delicate territory, and that could mean that Donald Trump at any point does change his mind. I mean, obviously, Trump has commented repeatedly about Europe. He does say that he sees unfair practices with Europe. He sees that US companies not being treated fairly. That's his view on that. And so at any point, he could decide that he's going to come at Europe. The question is, how prepared is Europe? How organized is Europe? And how united is Europe, particularly in any kind of response? And the unity thing is going to be really important for the EU.
Roz, thank you so much. Bloomberg's EMEA News Director, Rosalind Matheson. Now joining us is Goldman Sachs' Chief European Economist, Yari Sten. Yari, thank you so much for joining us. You come in the studio. I'm in Zurich trying to follow some of the news that we're seeing out there. I'm sorry about that. But Yari, there's a lot going on in markets. And for an economist, I guess you look at the impact that some of these tariffs have on inflation. It's unclear what Donald Trump wants, whether it's a deal or whether, you know, some of these tariffs will actually be pushed through. How do you view it going forward?
Yeah, I mean, as you said, it's a very fluid situation. It's very tricky to have strong views on magnitudes and timelines here. But to us, really, the key is the uncertainty that this is creating, trade policy uncertainty, broader macro uncertainty. And what we found in our work is that this trade policy uncertainty in of itself is likely to have significantly negative effects on things like investment, on confidence, and therefore on growth. This is very much what we saw in 2018 and 2019, when it was very clear, it was very unclear what size of tariffs Trump would impose on Europe. In the end, we got very targeted tariffs, but the uncertainty that was created in the meantime had very negative effects on growth across Europe. And we essentially have something similar in our baseline this time around. Trade policy uncertainty weighs on growth in Europe. We think it slows euro area growth by about half a percentage point, even though the tariffs in the end, we think, are going to be more targeted on the auto sector rather than being a broad-based increase in tariffs.
But Jari, given that we're seeing negotiations, we saw that with Canada, we saw that with Mexico, that tariffs have just been postponed by 30 days. What does it mean for Europe? Is that a blueprint of how it could happen with Europe, and what can Europe offer in return?
Yeah, to some extent, it probably is a blueprint. I think it's widely expected that Trump will propose tariffs on the EU, and I think the EU essentially has both carrot and stick to try to respond to this. I think the carrot is going to be to offer the US to buy more US goods, whether that's energy related or related to the military. And I think the stick would essentially be to say that if the US imposes tariffs on Europe, we would retaliate. And that's really how we think this will play out. But as I said, ultimately, we think a more targeted set of tariffs is likely, because we do think Europe is willing to buy more US goods, to raise military spending, and to help Trump achieve some of the broader geopolitical aims that he has towards Europe.
Jari, it seems that the ECB remained pretty unperturbed, especially when Christine Lagarde was commenting on the falling wage growth. Do you see the ECB staying its course no matter what happens with tariffs?
We do, yes. And I would agree with you that I think the commentary on wage growth was particularly confident. President Lagarde said, we have confidence in inflation returning to 2%. We are particularly seeing quite a lot of progress on the wage front, which we would very much agree with. When you look at some of the recent wage agreements in Germany, for example. So we do think we are on track back to 2% for inflation. And we do think that means that the ECB jobs at some level is relatively straightforward for now. We think they will continue to cut 25 basis points in meeting in March, in April, in June. That would take you to 2%. And then we think there's going to be one additional cut to 1.75% in the summer, because we think the trade policy uncertainties that we just talked about are going to weigh on growth and are going to lead to a weaker growth environment than the Governing Council currently expects. So when you take our growth forecast, we have 0.7% growth for the euro area this year. The staff projections from December have 1.1%. So we still think there's some downside there as the ECB incorporates these trade tensions into the forecast. And so that's why we think ultimately rates will head a little bit lower than the Governing Council comments currently imply, and then what markets currently price.
Jari, we also have, of course, big elections in Germany, February 23rd, that were upended because of domestic issues over the last 10 days or so. Depending on how difficult, I guess, a coalition building will be due, how much of that has an impact on growth, but also how to deal with Donald Trump. I mean, last time Germany was firmly in the eye of the storm. Yeah, I think it's very likely to be in the eye of the storm. Germany is most exposed within the large euro area countries to tariffs, and of course Germany also has struggled economically now for some time, hasn't really grown for a number of years. At the same time, Germany actually has the most fiscal space amongst major advanced economies, and so there would, in principle, be room for a fiscal response here. Now, we do think there's going to be some expansion of fiscal policy. We do think that the Conservative Party, which is ahead in the polls, would be open to some reform of the constitutional debt brake and increase in military spending. However, we think that will take some time. We also think the magnitudes are going to be a bit smaller than some people think.
And, of course, there's a risk that there will not be enough majorities to amend the Constitution when you look at the shifts in the recent polls. And so we would say, yes, there's a chance for some more fiscal support out of Germany, but I think it's unlikely to be quick enough, big enough to really turn the growth picture around in 2025. And so at the end of the day, that does leave us with a subdued growth forecast and with an ECB that is likely to respond to that.
All right, Jari, thanks so much. Jari Stender, of course, Chief European Economist at Goldman Sachs. Of course, we also have this week the BOE. That'd be really interesting, given there's a lot more market commentary that maybe the BOE and maybe sterling is now a haven. Now, Palantir shares have jumped pre-market after full-year revenue forecasts that exceeded analyst estimates. You can see, if you look at Palantir, gaining 18%. Now, best known for its national security work, and more recently, its AI platform, Palantir's stock actually surged 340% last year. Coming up, UBS tops profit expectations, but shares are under pressure over capital requirement rules. Our interview with the company's chief executive, Sergio Armotti. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
UBS shares reversing earlier gains, with analysts now viewing the company's results and the $3 billion buyback as already being priced in. Now, there's also uncertainty over capital requirement rules. Now, Chief Executive Sergio Armotti spoke to me about the company's performance and the ongoing integration of Credit Suisse.
The most critical part of the integration has been always going to be the migration, the data migration. We are migrating in total 110 petabytes of data. 15 have been migrated outside Switzerland. The big chunk of migration is going to start in a few months in Switzerland, where we migrate the balance, around 95 petabytes in 3 tranches, basically in the spring, late here, and the beginning of 2026. And this is definitely a journey that requires a lot of planning and a lot of good work, and the team is on top of it, but we cannot be complacent. So it's a very big task.
If you look at the regions, how are you satisfied with the progress in Asia?
Very good. I mean, in Asia, if you think about the fact that we have been growing very fast, but most importantly, we've been doing that while going through the migration. And so all our colleagues, front to back, have been somehow distracted by that, but at the same time, they were able to stay close to clients, grow assets, grow our business, and be a reliable partner. So in that sense, I'm also pleased to the progress we make in the U.S., both in the investment bank and also in wealth management, where we are now executing on our plans to restore a good level of profitability. And in the investment bank, we are gaining market share.
There's a lot of optimism of banking in the U.S. How will you take advantage of that?
Look, I think that we are in the U.S. is a very important market across the board for us. Is the largest wealth management market in the world. We are an important player there. We want to enhance our capabilities. We want to enhance our profitability. And in terms of the investment bank, we see a good momentum in the pipeline building up. Having said that, if you look at year-to-date volumes and activities in capital markets is down 26% year-on-year. So while it's a very promising pipeline, the truth of the matter is that the year has started in a rather slow way compared to last year.
But when you talk about enhancing capabilities, would that also be through acquisitions in the U.S.?
I think it's at this stage it's totally premature for us to talk about acquisitions. We have enough to do in order to improve our profitability with the current setup, and so we need to digest what we have on the table right now, and then we'll think about the future.
Sergio, I know it's been a couple of quarters where there's this overhang of capital requirements from the Swiss authorities. Any more information on what they plan to do?
No, look, I know as much as you do in terms of exactly what they want to do. We're going to know much more in May, according to the State Secretariat for International Financial Matters. The public consultations of the government proposals are going to be released in May. So hopefully the proposal will be aligned with the desire of the Swiss Federal Council to maintain a competitive financial centers and allowing UBS to be competitive in the marketplace, and for us also to be able to be a reliable partner to the Swiss economy.
But do you think they'll soften their stance from their initial proposal or press speculation because of what's happening in the U.S.?
I have no indication of, it's very premature to speculate what's going to happen.
Talking about the U.S., what do you expect for markets going forward? We've seen quite a lot of volatility. There's talk about these tariffs. Unclear whether this is a president that wants deals or would rather put tariffs and then think afterwards.
The market has started with some good momentum. You now see a little bit of volatility and dislocations. It's fair to say that the tariff topic has been somehow already priced in the market, and you can see it in the last few days, despite the fact that we are moving to the next level with the implementation of tariffs or the threat of implementation. You can also see the willingness of both parties to engage and negotiate, which I would say for the time being is okay. But any major positive or negative developments on that front will create spikes in volatility. For sure, negative outcomes are not priced in the market. The consequences for the economies, the affected economies, could be significant to inflation. I can see inflationary pressure coming out of tariff would mean that central banks would need to stop their easing path, potentially even reverse, something that is not priced in the market.
The UBS Chief Executive, Sergio Ermotti. Now, much more to come. We talk banking, we talk markets, and of course, we talk tariffs. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg. President Trump has signed an executive action to create a sovereign wealth fund for the U.S. Now, the president says Treasury Secretary Scott Bessent and Howard Lutnick, his nominee for Commerce Secretary, will spearhead the effort. Now, the action calls for officials to submit a plan within 90 days, including recommendations for funding, investment strategies, and governance. And the U.S. Secretary of State has told Congress that the U.S. Agency for International Development may be abolished after a review. Now, according to a letter seen by Bloomberg, Marco Rubio wrote that the current foreign aid process does not benefit the American people. He says some U.S. aid operations may be integrated into the State Department, with others shutting down. Coming up, we're live from the biggest port in Germany for special coverage of the global trade fallout and what that means for Europe's largest economy just weeks ahead of the country's election. This is Bloomberg. In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
Listen carefully.
Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Well, President Trump has reignited a trade war between the world's two largest economies. The European Union, he says, could be next in the firing line. EU leaders, including Germany's Olaf Scholz, have vowed to retaliate should the White House impose tariffs on the bloc. Now, such a move could inflict a serious blow to the continent's biggest economy with less than 3 weeks until the German election. Now, over the next half an hour, we'll hear from major players in German trade with special coverage from the port of Hamburg, a key trade hub for Europe. Well, Bloomberg's Oliver Crook is there for us. Hi, Ollie.
Yeah, Francine, thank you so much. Yeah, we're really at sort of ground zero for European trade and trade within Europe. The biggest port within Germany, the port of Hamburg, which has been around a very, very long time. The story goes that the area was first granted tax exemption by the Holy Roman Emperor Frederick Barbarossa, and they have the precise date for this, May 7th, 1189 AD. It has been a major thoroughfare for trade in Europe since the medieval period. It has a major role in the German growth story over the last few decades. It's really that international trade that has brought all of that wealth to Germany. The German model for many years has been based on globalization and free trade. And this, as of this morning, is seeing one of the biggest shifts in that paradigm in a very, very long time. So I'm very pleased to talk to some of the people that are actually building this sort of intricate trade network across the world. We're joined now by Axel Matter, and he's the Port of Hamburg's External Affairs CEO and Marketing. And basically, your function is to go out into the world and try to get people to bring their goods into Germany through Hamburg. I'd like for you to just sort of, set up for us the importance of this port for Germany and for Hamburg in the area more broadly.
Especially, of course, for Hamburg. Of course, it's part of the genes of the Hamburg's inhabitants and government. But the importance for Germany, and especially also for the whole of Europe, is vital. Vital for trade, vital for trading with all the international partners worldwide. And you can see it from the services which are going from Hamburg into the whole world. So, of course, led by Asian trade and then followed by US trade, but you can reach every corner of the whole globus from Hamburg, port of Hamburg by ship.
And you mentioned Asian trade and US trade, and as of this morning you have a trade war between China and the United States, and 1 in every 3 of these containers behind here is coming from China. When you see the last 48 hours, as you have from the United States, from Donald Trump, what do you make of that? How does that sort of impact the way that you're thinking about your business?
From the port perspective, we are usually not reacting on a day-to-day basis. So whenever it's happening, and we see what he did, Trump, he raised some taxes and then he dropped the taxes down again just in the last 48 hours. So we are quite reluctant on that part because we are more on a long-term basis looking on international trade.
So talking about that long-term basis, what are the things that are going to grow, that are sort of the growth engines for you, and how are you trying to grow and sort of develop this port to be something even bigger?
Yeah. So as a port, you have to invest in infrastructure. And this is quite a lot of money you have to invest for a very long time, like 30, 40, 50 years. You have to make the port more efficient, and especially in Hamburg, it's very interesting because you have a port which is just in the middle of the city, surrounded by the complete city of Hamburg, and we have no possibility to grow. So we have to do more efficient, more effective operation of the port activities on the given ground. So that's our main concern, to be perfectly prepared for whatever happens in the future.
And when you're trying to grow these markets, you're traveling around the world, you're traveling to China, you're traveling. So what are the sort of most promising markets for you? Where do you think we're going to see more exchange between Germany? Is it going to be potentially India? Because we know there's the de-risking strategy from China.
Yeah, that's right. So India is the most rising market these days. So it's very interesting for us. I mean, it's a huge country and there's a lot of activities, but you can't compare it right now to China, because China is still by far the biggest trade partner from the port of Hamburg, from the port perspective. So 1/3 of the containers are being handled in the port of Hamburg are coming from China or going to China. And so, but US market is quite interesting and it's a market which is connected to Europe since the trade started.
And then also some of the things that you're trying to develop here is the types of trade, the types of cargo that you can take. For example, hydrogen is sort of looking into the future, potentially more on LNG. What are you looking to develop in terms of the types of cargo you can accept here?
So that's a very not a difficult question, but you have to put that you have to define it a little bit, because the hydrogen and methanol and ammonia market is divided in two parts. You have the market for serving the ships with fuel, for example, and then you have to import a lot of these derivatives for the country, for energy perspective. And that's something where we are preparing the port very and on a sustainable way. We have a lot of industry which is gone by now. For example, mineral oil refineries are gone, so we are trying to refurbish the whole area in the port for hydrogen.
And we're just a couple of weeks away from the election here in Germany. What do you need from the next German government in order to continue to make this a prosperous location?
The promise that the government is investing in infrastructure. That's for us the most important thing, because infrastructure is the most important thing we need as a port, because the infrastructure is guaranteeing for us the connection between the port and the clients and the industry.
And when you go into this election, the party that is the second strongest within Germany is one that is certainly has a very anti-globalized sort of perspective, I think it's fair to say, and is already affecting the debate, even if they won't get into power. What is your message to sort of the German people if they are sort of concerned about this sort of future prosperity and the place that trade holds in that with a party like that coming in potentially?
So my message would be you have to vote for democracy and not for the right wing. That's even worse, going for trade, for whatever is important for the German inhabitants. I mean, we are in a democracy and we need to keep it, and so we have to vote for the democratic parties.
Well, Axel Mattern, thank you so much for your time speaking there to the Port of Hamburg External Affairs CEO and Marketing, and really going out and building those relationships in order to bring more and more of these containers into the German and European economy. But up next, we're going to be speaking with our exclusive interview with the CEO of one of the world's largest shipping companies and why he thinks that the U.S. tariffs will only have a limited impact in the short term. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back, everyone, to our special coverage of how Donald Trump's tariffs could actually impact Germany, Europe's biggest economy, which goes to the polls in just a few weeks. Now, as the U.S. and China start a new trade war, EU leaders have been scrambling to avoid their own trade war with Washington. The German Chancellor Olaf Scholz says Europe has the capacity to react if Trump follows through. But what's the view on the ground? Let's return to Bloomberg's Oliver Crook at the port of Hamburg. Hi, Ollie.
Yeah, Francine, I mean, listen, this is absolutely critical to the German economy and more broadly because, you know, more than 90% of all goods that are moved around the world are moved by sea. And one of the companies that is principally involved in that is Hapag-Lloyd. They have about 10% market share in all of the container traffic across the world, shipping them all over the place. And we spoke with the CEO yesterday exclusively, and he told us why the U.S. tariffs could really have a limited impact in the short term, but long term could really do some damage to the sort of global picture, particularly if there's a step towards deglobalization. Have a listen.
Well, in the end, of course, it's not totally unexpected, as it has been announced already some weeks ago. I think in the end, the effects on global trade will probably be somewhat limited. I think especially the 10% on China will not do all that much, also because we've seen a recent appreciation of the US dollar anyway, compared to many currencies. So short term, I don't expect to see a lot of effects from that, but longer term, of course, tariffs are never good for global trade.
And do you think that, you know, so you say probably not a reduction of volume. Do you see trade reorienting as a consequence of this? Have you been speaking to clients over the last couple of days? What have they been sort of saying?
I mean, in the end, I think trade normally finds a way. If you look also at the first period where Trump was in power, there were quite a lot of tariffs, and there were actually also under the Biden administration. And what you see is that trade flows then typically shift. And we've seen less volumes from China, but instead we saw more from Southeast Asia and also, for example, from India.
And do you think that you could, as a consequence of this and sort of maybe the relationship with the United States getting a bit more strained, do you think you could see those volumes from China increase? Into Europe, that is?
Could be. I mean, China will continue to produce, and then we have to see where those goods are going to go. I think that's always, it's always difficult to predict what's going to happen. In the end, though, I think the U.S. administration will also want the American economy to grow. And if the American economy grows, then they will also need to import goods, because many of the things that are being imported today will not be manufactured in the U.S., also not in the foreseeable future.
Have you modeled what tariffs on Europe would do to your business and to volumes here?
It's always very difficult to predict that, because, as I said, there's also the FX effect. And in the end, normally we see that the effects of tariffs are less than people predict.
And then in terms of the question of the broader question, because you mentioned this and sort of stepping back, there is certainly a trend, it seems like, of deglobalization and wanting to sort of move production within sort of borders, within sort of blocks. Do you think that that can put a cap on your growth longer term? How do you see that playing out?
If you look at what's been happening over the last couple of decades, then we've seen that the multiplier of GDP has come down when you look at global trade, but global trade is still growing. Even if you look at the last 5 to 10 years, you still see on average 3 to 4% growth. Some years it's more, some years it's less. I think if we look at 24, then the market certainly surprised to the upside. So I do believe that this long-term trend of seeing maybe anywhere between 2 and 4% growth on an annual base is still there. And of course, there will be bumps in the road. But the longer-term trend, I believe, is still intact.
And in the context that we've seen from the United States, are you looking at different markets for growth? Are you hoping that that's sort of where the 2 to 4% comes from will be different over the next couple of years?
I think when you look at the trades, of course, not all of them are going to grow at the same pace. But I think that, for example, when you look at markets like India, but also Africa, they will certainly grow above average. And of course, in return, you'll see some of the trades to and from Europe and possibly also to and from the US may grow a little bit less.
I'd also like to get your thoughts on the German economy more broadly. Obviously, Hamburg is a huge part of the sort of trading story within Germany, which has been a huge part of the wealth creation within Germany. In terms of heading into this election after 2 years of stagnation in the German economy, what do you think? What would you like to see from the next government, no matter who it is, in terms of supporting the German economy? What do their priorities need to be?
Well, I think it's very important for the German economy that we get growth going again. I believe that's also where most of the parties are united. And of course, that means that you have to take all kinds of measures to ensure that we remain and become, again, even more competitive. Germany has proven in the past that they can do that, and hopefully they'll be able to do it again over the next decade.
And there are the thoughts from the CEO of Hapag-Lloyd, one of the biggest shipping companies in the world, based here in Hamburg. Also based here in Hamburg are the Hamburg Chambers of Commerce, which are actually the oldest in Germany. They've been established back in 1665. Today, they represent more than 180,000 businesses in the region. And I spoke to the CEO a little bit earlier, who told me that he's quite pessimistic after the President Trump Sunday said that the European Union could soon be hit by measures. Remember, those are potentially 10% measures coming in against European tariffs. Have a listen.
It's hard to actually calculate what is the impact. It's going to be a bad impact, and also we put other tariffs from the European Union. This is all we need, more free trade as a destination. But to see our economy in Germany is lacking of competitiveness in international regards. Yeah? So we have too much bureaucracy, and energy prices are too high, and all things like this. Tariffs making exporting goods more expensive. So we need to reduce anything and to train our competitiveness. Yeah?
That the Hamburg Chambers of Commerce there. But coming up next, what tariffs could mean for a German economy already on the brink and how the next government should respond. We'll discuss that next with the German Marshall Fund. This is Bloomberg.
Bloomberg Invest is back. Join me, Sonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
To me, the most beautiful word in the dictionary is tariff, and it's my favorite word.
As the United States and the EU square up to what could be the next front in Trump's trade war, at risk is the biggest and most integrated bilateral trade and investment relationship in the world. There's no free trade agreement between them, but operating under WTO rules, they enjoy some of the lowest tariff rates anywhere, at about 3%. The EU and the US trade about 850 billion euros worth of goods, with Europe running a surplus of about 155 billion. Meanwhile, trade in services was worth almost 700 billion, where the US runs a surplus of about 100. Combined, the exchange of goods and services was bigger than almost every single European economy on its own, at least for now.
And remember, again, the word tariff. We're going to protect our people and our businesses, and we're going to protect our country with tariffs.
According to Goldman Sachs, a 10% minimum tariff would reduce EU exports by about 150 billion euros every year, shaving off about 1% of European GDP. And Germany would pay the highest price. Germany's effort to de-risk from China has meant the trade relationship with the United States is more important than ever, and new tariffs by Donald Trump could cost Germany 15% of its biggest export market.
So the potential that the impact that Trump's tariffs could have on the EU and how Germany is hoping to could be paying the high price out of all that, particularly as it tries to de-risk from China. The emerging trade war between the US and China leaves Germany trapped between its two biggest trading partners, and that could spell more bad news for the economy that has already contracted for 2 consecutive years. Let's bring in Sudha David Wilp, who is a senior fellow at the German Marshall Fund. Thank you so much for joining us, Sudha. And I'd like to just begin with your reaction to the last 48 hours of what we got out of Trump and the ominous signs that we're getting about what we could be getting next for the EU, and basically how the German government and potentially the next government is going to be viewing that.
Thank you so much, Oliver. Good morning to you. So if we start with just the immediate reaction about the pause in tariffs on Canada and Mexico, I still think that Germany and its European partners still see the fact that President Trump is so insistent on implementing tariffs as a harbinger of things to come. And Germany and Europe has certainly prepared. There's a list of retaliatory measures that the EU can put into place if tariffs do come about. But I think Germany, as Europe's largest market, has been seeing the writing on the wall for quite a while. It is caught between the two economic juggernauts of the United States and China, and the United States even being protectionist under the Biden administration, but tariffs, of course, take it to another level. And then, of course, dumping measures on the part of China and putting Germany's automotive industry in a very, very difficult place. So Germany is trying to find its place in the world. It's known as the export powerhouse and has built its reputation, it's built its power on globalization and open trading markets. And that model is not current at the moment.
And do you think that this latest action by Donald Trump, obviously the message from the German government for a few years now has been de-risk, de-risk, de-risk from China. Do you think that this could change that at all? Is there a silver lining anywhere here for Germany and Europeans to maybe say, hey, listen, we're open for business and we can actually be the beacon of global trade?
So many European policymakers, and here in Berlin, and of course, Germany is in the throes of an election campaign, and we can talk about that in a moment. But I think there is a certain amount of resignation that some sort of tariff will come, but also many think that it's perhaps an angle for negotiation. And Europe can respond and say, look, we will counteract any tariff by A, B, and C. But at the same time, we can spend more on defense and make sure that our Euro-Atlantic common interest threats are addressed jointly. We can buy more LNG from the United States. we can do more to reconstruct and keep stability in Ukraine after President Donald Trump figure out a way to solve that conflict. So I think there are definitely ways in which, or avenues in which Europe can talk to Donald Trump and persuade him to perhaps forego the most draconian tariffs. But I think there is a resignation that the world has shifted and there is more industrial policy coming from China and coming from the United States. And Europe may, at the end of the day, always choose, also think that they should play China and the United States off of each other if Donald Trump pushes too hard.
Yeah. And I want to just get your thoughts very quickly on kind of the latest developments within the German election campaign. You had probably the most kind of significant development over the last few days with Friedrich Merz sort of voting with the AfD and then backtracking, and then the measure didn't even pass. I'd like to get your sort of analysis of how that is going to play in this election campaign. I have to say I've been pretty surprised that so far the polls have been basically unchanged.
Yeah, the polls have been quite stagnant, even since, after the holidays. The AfD, the far-right party, has been consistently getting 20% of polling, and the CDU has been hovering at 30% or a little bit less. Now, conventional wisdom says that Friedrich Merz will be chancellor, but because of his move to put migration on the forefront of his campaign last week instead of economic competitiveness, something that Brussels has also been stressing and that many business leaders and policymakers see as a very vital issue for Germany moving forward, he decided to align with sort of ideas from the AfD and go maximum on terms of migration in Germany, knowing that perhaps this would only go through with the AfD, which it did not. The motion passed, but the law did not pass. But now Friedrich Merz is trying to pivot and put economy at the front of the campaign. And we'll see what happens. I think we still need a week or two for Germans to digest and understand sort of what happened last week about the CDU allowing itself to align with the far-right party for the first time in post-World War II German history.
Right. Well, Suda, David Wilp, thank you so much from the German Marshall Fund. And that's really it from Hamburg here. Francine, I'll hand it back to you.
Yeah, we continue to focus, of course, on Germany. 9 a.m. UK time on Thursday, a conversation with some of Germany's most powerful chief executives before the votes are cast, and that will be with Tom McKenzie in Frankfurt. Now, let's also look at what the UBS results actually showed us. Shares trading sharply lower, reversing some of the earlier gains. Analysts pretty much concerned about capital requirement rules and probably think the company's results with a $3 billion buyback were already priced in. You can see UBS shares today, actually over the last 2 days, down 7.7%. Up next, Bloomberg Brief, Manus Carney in New York, and this is Bloomberg.
First time, or got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. but you should put Wi-Fi in all your boxes, and that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley and LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute global financial news whenever and wherever it happens. I'm Jonathan Ferro.
And I'm Lisa Abramowitz in Davos, Switzerland, and this is Bloomberg.
Good morning from our global headquarters in New York. I'm Manish Kreni. You're welcome to Bloomberg Brief. Let's set that agenda. Mexico and Canada granted a one-month stay of execution on tariffs as China delivers a calibrated response to Trump's opening salvo. Determining the course of war, Israeli Prime Minister Benjamin Netanyahu prepares to meet with President Trump at the White House. And an untamed AI demand, Palantir surges after giving an upbeat outlook. Infineon warns of the tariff risks. Good morning. Straight to the FX narrative. You can see here that it is all about the yuan, and that is where you are seeing 10% tariffs kick in. The opening salvo seems like a calibrated response, so a little bit of a shift in the yuan, which is down in the dollar there. Dollar Mexico, a virulent day yesterday, regaining some of its footing as we go into this 1 month pause in negotiations. Down 3% yesterday, and they turned it around. Wells Fargo says of the Canadian dollar, the loonie as it's known, is that it's still too little priced in for tariffs. How does that play out to the equity market? You have two reprieves for Canada and Mexico, and you have a live set of tariffs now, trade war live with China in the second Trump presidency. And what you have here are equity markets grappling. S&P regained most of its 2% losses yesterday. Do we know more about the Trump put? Do we know more about tactical tariffs rather than perhaps enduring tariffs? But still, the risk remains for a 5%, maybe even a correction, according to Laurie Calvasino. The bond market, it was all about flatteners yesterday. Here we are, 457 on the duration, which is up 2 basis points. We need to debate the differential of whether stagflation is still a very live threat. There's some stocks we're keeping an eye on as well. You have Palantir, as I said, in the headlines. Soaring pre-market. The software company gave a forecast that was stronger than expected, fueled by the demand for, you got it, AI, up under just 18%. Spotify rising. Streaming company reports earnings before the bell today. Investors are looking for signs that it can keep its subscriber momentum and profitability. And BNP Paribas announced a new share buyback and a higher than expected dividend after a surge in trading revenue in the final months of 2024. And in just a few moments, we'll sit the risk agenda with Mads Pedersen of Human Edge Investments Technology. And later in the hour, Adam Posen of the Peterson Institute joins me. and an exclusive interview today for you on Bloomberg Brief. Barrick CEO, I should say, Mark Bristow, joins us from the mining conference in South Africa. But let's reset to our top story. China has retaliated to President Trump's 10% tariff, Beijing imposing 10% levy on oil and a 15% tariff on U.S. coal and LNG. Google also being targeted in an antitrust probe, and some other American companies also on the target list. But President Trump struck temporary deals with Canada and Mexico, and he's looking for the same with China.
We'll be speaking to China probably over the next 24 hours. China's involved with the Panama Canal. They won't be for long, and that's the way it has to be. If we can't make a deal with China, then the tariffs will be very, very substantial.
Joining us now is Oliver Crook on the road of tariffs. China's response, Oliver, let's just start there. It's being described by many in the market as careful, calibrated, and we have this window through to February the 10th before these tariffs actually kick in for the U.S., and that's the source of optimism here.
Yeah, I think that it very much is, Manus. And I think just to sort of set the scene for where we are here today, we're in the biggest port in Germany. So we think about the sort of trade, we think about the sort of billions and trillions of dollars in the abstract, but really it comes down to places like this where you're seeing the physical containers move. I mean, a third of these come from China, and it is exactly going to be caught in the crosshairs of this U.S. and China trade war. What I think is very interesting is that, yes, as you say, Manus, it has been a measured response. It seems that, Trump really wanted to dial up the rhetoric, really do up those 25% tariffs, and then just sort of dial them back. But really, what's also interesting is the way in which, not just with the Chinese, but also the Trump administration, you're starting to see these things overlap. It's not just about trade. You're seeing it also in antitrust, and that is a lot of the sort of vocabulary that the Trump administration has also been talking about with Europe. It's, yes, about trade, but it's also about regulating the big tech companies. So I think it also sets a precedent for what these next 4 years are going to look like, how these things are going to sort of bleed into one another. And I think it's also interesting to see that with the China and the U.S. sort of tariffs, another consequence will be here in Europe. When you see sort of tariffs go up, for example, the Chinese retaliating against American fossil fuels, that will mean that potentially some of that LNG can come over here to Europe, which is obviously good news for Europe. The bad news, however, is that if some of these goods can no longer go to the United States, much of that capacity potentially gets redirected to Europe, and that is a major problem for Brussels, who's trying to struggle right now for getting their own companies competitive and competing against those cheaper products from China.
Oliver, I would say it's very much about spheres of influence, geographic spheres of influence to the north and the south for the United States. And it was interesting, the recalibration in terms of how President Trump described his conversation with Sheinbaum in Mexico and how he referred to Canada. What did they have to give him as a policy of appeasement?
Yeah, so I think this is really very interesting, Manus. I mean, listen, they got the deal, so-called. They got the delay of about 30 days, both of them to sort of put more border guards on each of the borders in order to secure the borders about, for illegal migration from the south and then illegal drugs on both ends. That is going to be the sort of first thing. But the question is going to be, obviously, Manus, for the Canadians, for the Mexicans, and for anybody who is negotiating with Donald Trump is what happens after a month? Will those demands stay the same? Will they change? And for companies that are trying to figure out their trade routes, who are trying to figure out making this very long-term planning, it does not create the environment of massive stability for these companies to do that, and that is going to have a long-term influence. It sort of shatters in some ways the sort of global order and the sort of stability that has been so absolutely crucial, particularly to countries like Germany, where for decades and decades it has been the main engine of growth. It has been able to export their goods and have that sort of global trade agreement, and that is going to be very, very sort of concerning for them, particularly as he's been teasing that, the EU could be next with 10% tariffs. That is going to hit hard right here in the port of Hamburg, the very heart of European trade.
Well, to use the president's own words, they've been very, very bad to us. Oliver, thank you very much. Great work, Oliver Crook, on the tariff trail. So the trade war isn't completely off. What does it mean for markets? Joining us now, it is Mads Peterson, CIO of Human Edge Investment. Mads, it's been a sort of a hectic 72 hours, maximum angst to a moment of relief. When you see the kind of swings in policy risk, you've actually taken action to recalibrate your risk. Is that as a result of tariffs, or are you front-running the worst-case scenario?
Well, the tariffs is the last parameter, the last thing which makes us take the move, but we're following our investment process. The real thing which has happened is the positives have moved away. Inflation is no longer going down fast enough that it forces the Fed to cut. Trump has endorsed them staying at neutral, probably because he doesn't want to have a domestic war when he has a trade war. And we see that the positive drivers are not there. This is going to be a year of trade war, and we want to start the year. We had a very good gains in January, and now we want to be more cautious. But this is the flipping over point where we have moved from 100% equities to 60 in our portfolios. And if we look at the context, well, China has generated the world's largest trade surplus, and now they get the effect of that. So in a sense, it's more the basic macro, but the basic macro is driving the trade war. So it is a reaction to that as well.
When you look at the kind of FX volatility that we've had, which is the very first response muscle that we look at, it's the very first flex that you really see. And then you see the equity market down 2% and pulling that back. Did you learn anything over the past 72 hours about this fabled Trump put?
Well, I think we learned that what we already knew. I think the biggest thing we have learned the last 24 hours or the last 72 hours is that the world is still not prepared for Trump. And the world is, shockingly enough, the German politicians, the Mexican politicians, you can like Trump or you cannot like him. Americans have elected him. And they are not ready for his new vision, which is he will play all over the plate. You heard him talk before. He talked about the Panama Canal when he talked about trade. He plays the whole plate, he plays the whole game, and he wants to change the things. So the real shock is that the rest of the world is not ready for that still, because much of what Trump said, he has been saying for months and maybe years.
Yeah, I mean, the shock is that people are shocked. If this is his if this is his opening trade salvos, I put it to you that this is going to be a much more aggressive foreign policy. This is about spheres of influence to the north and to the south and here in the west of the globe. With that in mind, how much more defensive do you need to be from a tactical asset allocation? You look at gold at a record high, you look at a dollar at a 2-year high. Are those your natural levers of defense?
No, the natural lever of defense is the middle of the US government bond curve. We're buying 3 to 7 year ETFs, for example, 1 to 3 year US government bonds. If the Fed had been more stable, we could buy longer duration. But the things which will really go up if things go really wrong are the long duration US government bonds. There is 2 currencies in the world which are stable. There's the Swiss franc and there's the dollar. And the Swiss central bank has cut very much. So what will happen if things go wrong is the dollar will strengthen the US treasuries. And that we have seen confirmed now. So the other things would be too volatile for us. But we have reduced equities with, in some portfolios, 40% down to 60, and others from 70 down to 40. And we have reduced high yields back to neutral as well, taken off 30%. This is what I think is reasonable to do now. The world is still in a very good, as I used to call it, a beautiful transition into a very strong growth era. Yeah, so we still have a very strong global economy, but China can no longer drive their growth with export, and Germany has not grown for 5 years. It's much more likely Germany goes into recession than to strong growth this year. So it's not a great year for everyone.
Okay, the belly of the curve, 3 to 7 years and shaving on equity risk. Mads, thank you very much. Preparation for an uncertain future 2025. Mads Pedersen there of Human Edge Investment Technology. Coming up on the show, the Israeli Prime Minister Netanyahu touches down in Washington. More on his meeting with President Trump. That's next.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's Bloomberg Brief. I'm Manus Cranny in New York. The Israeli Prime Minister Benjamin Netanyahu is in Washington. It's for his first international visit to President Trump's second term in the White House. The truce in Gaza, which began just before Trump's inauguration, is ongoing, but Netanyahu faces pressure from within his own government to claim a victory against Iran-backed Hamas militant group in Palestine. Joining us now with the details is Kevin Whitelaw. Kevin, before he got on the plane, he was bannering this trip as being the first international visit and leader that Trump would meet at the White House. So this is about personal branding, but this is also trying to reinforce his cabinet around him, isn't it?
Absolutely. I mean, for, Benjamin Netanyahu has a lot at stake as he goes into this meeting with Trump. And Trump has something at stake, too, because obviously President Trump has put a fair amount of his own political, sort of capital into the ceasefire. He's claimed a role in it, and he really wants to be able to move past the conflict with Hamas. But for Netanyahu, it's obviously a matter of political survival as he still faces pressure from the right-wing parts of his coalition to continue to press the fight against Hamas. That will not go over well with Donald Trump, and Netanyahu knows he's never going to get a friendlier U.S. president than Donald Trump. So definitely they want to try to find some way through this that preserves the ceasefire while keeping Netanyahu in power. And I'm not quite sure how that happens yet, but that's going to be what's at stake there today.
Yeah, it's about progress to phase two, although his lines before he got on the plane, it's about the progress on redrawing the map and making more progress. Talk to me about Scott Bessent. The Treasury Secretary, Scott Bessent, has been accused of breaking federal law by giving Elon Musk, now this is access to Musk and the Doge team, access to government and personal financial information, which the president pushed back against yesterday in the Oval Office.
I mean, that's right. This is a very unusual situation where we have essentially non-government employees, because this Doge structure is kind of outside of the government. They're not exactly all paid. It's unclear what the status is. They don't have security clearances as far as we know, but they've been given access to one that's a very, very sensitive system that processes payments for the federal government. So we're talking enormous sums of money. And no one really understands exactly what they're doing there, under what authority, and sort of whether this is at all legal. Donald Trump has obviously said this is all about trying to just understand what is going on and understand what's being paid. Obviously, getting a handle on the federal spending in the U.S. is incredibly complicated, but this definitely is, there's sort of no precedent for this at all. There's already lawsuits out there by the unions saying this is not at all appropriate. I mean, these are things that career officials spend their entire lives learning how to do and to deal with and to follow the law. And so there's a lot of concern about what exactly is happening behind the scenes there.
Well, look, there were a lot of executive orders signed yesterday in the Oval Office, and one of them was to create a sovereign wealth fund for the United States of America. Larry Summers spoke to Bloomberg in November about the potential for a fund. Here's what he said then.
A broad-based sovereign wealth fund, a kind of slush fund for government to do what it wants, achieved by borrowing money. I really don't see the logic at all.
Now, I was listening to that news conference yesterday, Besson saying we're going to monetize the U.S. balance sheet. How are they going to do that? What is the plan for this sovereign wealth fund?
Well, I don't think we really know the plan yet. Obviously, most sovereign wealth funds are funded by sort of, like clear revenue sources, usually natural resources or some other kind of revenue stream. It's not really clear what Trump would actually use to do this, except for perhaps more borrowing, something he has shown he'd like to do. He floated the idea of maybe using it to buy part of TikTok or buy TikTok for the U.S. government. I mean, he's floated a lot of different ideas. We're going to see over the coming months what kind of plan actually shapes up, but it is something an idea that Trump had floated a while ago. So there's going to be there'll definitely be an effort to make something happen. I think we need to be pretty skeptical about the size and scale of what actually will end up materializing here, though.
Yeah, everything was floated yesterday, from TikTok to vaccines, multiple of things that could potentially go in a U.S. sovereign wealth fund. It's the funding of it that counts. Kevin, thank you very much. Kevin Whitelaw there on the very latest political machinations from Washington. Coming up, Palantir soaring after what it called untamed demand for AI. Unleashed, untamed. We'll tell you what that means in just a moment on Bloomberg Brief.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you probably wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and a beer in my hand.
Don't miss the next Open Interest.
Front-page news from around the world. Let's kick it off with the Journal. They're reporting the Trump administration officials are weighing a plan to dismantle the Department of Education. Now, it would shut down all functions of the agency that aren't written explicitly into statute or move certain functions to other departments. The White House didn't respond for a request for comment from the Journal. Next up, the Financial Times leads with Citi CEO Jane Fraser there. This is a bit of a move, telling employees they can go back to working at least 2 days a week from home. Fraser pledged to maintain the hybrid work schedule. This comes even as other banks up their in-office mandates. That's what you call capitulation. Bloomberg, we're leading with Palantir, giving a full-year revenue forecast that exceeds the estimates as a result of AI demand. The CEO, Alex Karp, described untamed organic growth. What is untamed organic growth? This stock was up 340% last year. Tom McKenzie will fill me in. I mean, look, we know these guys are big in defense, but wow, what an order book they've put in front of us.
Yeah, exactly. They see sales of $3.75 billion US for this year, well above the estimates. In the most recent quarter, they saw revenues increase 36%. They've seen a 45% increase in terms of sales to the US government. If you want an example of a company that's getting the ROI on AI, then it is Palantir. They've invested in the software around the defense capabilities that they supply into the US government. Every single arm of the US military now uses this software, as does Ukraine, as does Israel and other allies of the United States, and they are benefiting from that. And that line really stood out, didn't it, from Alex Karp in terms of that untamed organic growth. He also commented, by the way, on Trump, on Doge, on Musk. He sees all of those efforts around cost cutting as actually benefiting Palantir longer term.
That's what you call being well prepared for the press conference. Morgan Stanley's just up the price target at $95 from 60. And then you take Infineon. I think this is interesting, Tom, because if you look at the quarterly forecast from them, ahead of the analyst estimates, we caught up with the CFO, and this is what he had to say about tariffs.
A major escalation of the tariffs is not included in our guidance because we still are not giving up in advocating for free trade. We do not see that as positive for the industry. So an escalation of tariffs and counter tariffs would be negative.
So, Tom, just caught up with Mads Peterson there 10 minutes ago, and he said, look, the world industry is just not prepared for what's going to come at them, whether it's trade or politics. If you look at Infineon's numbers, I mean, there's a certain naivete in terms of not going deeper into the tariffs, but what do they tell us about the base demand here at this juncture minus tariffs?
Yeah, and look, maybe that naivety will come back to bite them, particularly given their exposure to the auto sector and the weakness, or at least the challenge to the auto sector as a result of tariffs, if they come through for Mexico and Canada, on now, of course, on pause. So that potentially is a key risk for them. But this is also about expectations. We come into earnings for the likes of NVIDIA with very high expectations. The expectations were very low for Infineon, given their exposure to the autos, to industrial space, and essentially they more than matched those very low expectations. It's still a challenge, still soft. In terms of quarter-on-quarter, sales into the auto sector were down about 11%, but they seem to be managing their inventories better than some of their competitors like ST Micro. They are also getting a bit of an offset in terms of the demand coming through for data centers. They're benefiting from that as well. So the stock, the last time I checked, up double digits. Over the last 12 months, it's flat, but in terms of the inventory story, it seems to be improving, but you're absolutely right to point out they have yet to price in the impact of potential tariffs.
By the way, they're not the only ones to sort of leave tariffs off the modeling that they give to the market at this stage. Tom, thank you very much. We'll get Google's numbers later today. We'll bring you those as they break. Tom McKenzie in London. Coming up, impact scenarios of President Trump's tariffs. Adam Posen of the Peterson Institute joins me to put some context where it matters on Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, I'm Manus Rennie. Welcome to Bloomberg Brief. Let's set that agenda. 1 month stay of execution on tariffs for Mexico and Canada as China delivers a calibrated response to the Trump tariffs. Determining the course of war, Israeli Prime Minister Benjamin Netanyahu proposed to meet President Trump at the White House. And an untamed AI demand, Palantir surges after giving an upbeat outlook. Infineon warns of tariffs risks. Good morning. Straight to the FX zone is where we look for the reaction function. You've got the yuan down by 0.3% as 10% tariffs go live and China goes for a calibrated response to the opening salvo. So a very small weakening in the currency. The Mexican peso regains its footing. They have a 1 month pause. They've got time to negotiate. That was down 3% yesterday. So that's coming back to par. And the Canadians, who Wells Fargo say the loonie, which it's colloquially known as, you need to be a little bit shorter of this as there's too little tariff risk priced in there. To the equity market, you've got two reprieves, one on Canada, one on Mexico, and calibrated response from China. So the equity market at the moment is flat. The S&P regained its losses yesterday. The consensus is now building that these tariffs may be more tactical than enduring. Your risk is a 5% drawdown. And Mads Peterson of Human Edge has just said, look, we're shredding our equity exposure across the portfolios because this world is just not ready for what Trump is going to do. To the bond market, and this is going to be, again, a recalibration. Yesterday was all about flatteners. The short end up at one juncture by 8 basis points, comes back to flat. 425 is where we are. What are your risks here? Downside growth shock, and therefore less upside inflation. So maybe it is a little bit more about flatteners. Let's talk and get a little bit of a recap on these tariffs for you. If you're just tuning in at 5:31, China has hit back 10% tariff on oil and agricultural machinery, 15% on coal and LNG, and a probe into Google, amongst other companies. For Mexico and China, they have 30 days until the levies kick in. I'm pleased to say Adam Posen is the president of the Peterson Institute. He joins me now for International Economics. Adam, good morning to you. I am not a game theorist, but 72 hours have passed of where we've gone from max hubris and pulled back from the brink. How important is the signaling that we got yesterday over Mexico and Canada?
I think we have to look, Manus, at this as signaling of intent and of risk and not focus on whether Trump gets to declare victory or Mexico or Canada gets to declare a reprieve. I view this as sort of a test balloon establishing a sense of uncertainty and fear. I view this as a potential prelude to the Trump administration trying to pass legislation to put wide tariffs in as part of the tax code. And I view this, particularly with the tit-for-tat retaliation from China, as actually the beginning of some asymmetric conflict between U.S. and China. As you noted, China's putting an investigation into Google. It's naming various companies to their version of the entities list. They're not going to stick with just tariffs the way the U.S. is not stuck with just tariffs.
For me, this comes down to actually spheres of influence to the north and the south with Canada and Mexico, which is about policies of appeasement that they've offered. But I want to just drill a little bit more into China. Step one is a 10%. There is a window through February the 10th. You say don't be lulled into a false sense of security about the calibration from China at this juncture.
Yeah, I think China had, during Trump 1 and in various other contexts, has pursued a very, I think, reasoned or reasonable approach to these things, which is pretty much WTO consistent, which means proportionate tit-for-tat tariffs, but then always having a bit of a kicker. And the kicker that they've put in this time with the Google threat and with the entities list and with the restrictions on certain exports like tungsten, that is a level higher. Now, again, is it a huge deal for the U.S. economy right now? No, but is an indicator of where we could go. That said, I think, Manus, what you touched on is Trump seems to be out to create a Fortress America. Whether that's a Fortress North America or a Fortress USA remains to be determined, probably trying to make it at least a Fortress USA Canada. So I think I'd be more worried about escalation returning on that front than I am about China in the near term.
Okay, that's interesting because what we saw yesterday was, I would say to you, a policy of appeasement by Sheinbaum and by Trudeau in terms of troops, a small number of troops in the scheme of things, Adam. But talk to me about this foreign policy move. You and I, as we walked out the building, I talked to you about Disraeli in the UK in the 1900s, and I put it to you that that is what this is, splendid isolation for the USA.
Yeah, I think that's a good classical reference that's relevant. I wouldn't focus, again, it's true that President Sheinbaum and Prime Minister Trudeau, both of them managed, although President Trump obviously acceded to this sort of kabuki game of doing things they already wanted to do and letting Trump claim victory, something similar to what Colombia did over the deportation flights. But that doesn't bind Trump in any way going forward, and that doesn't change the underlying pattern of interest. It's possible this is all just theater. I think that is underestimating the intent and power of the American president.
So, Adam, do you think there's a real risk that we go back to those maximum potential tariffs, not maximum, but the initial tariffs, i.e. 25% on Canada, 25% on Mexico? Do you think that's still a very real risk, because that's got consequences for the Fed and stagflation?
I think there's a very real risk that come April, there's going to be a 10 or 15% across the board tariff proposal through the Congress, and that there will be punitive tariffs continuing to be placed on Mexico. I think the 25% tariff on Canada is much less likely, especially assuming a change in government.
And the driver of this, you say, and we qualified this is about legislating these tariffs within the tax bill. What is the consequence of that, and how important is that for the deficit?
It's a double-edged sword. So if President Trump's administration gets the Republican majorities in Congress a across-the-board tariff, then it counts for the calculation of projected revenues when they have a reconciliation bill, which is Washington speak for how to get a bill through the Senate on the budget with only needing 51 votes. And so estimates done by Kimberly Klossing and Maury Obstfeld at the Peterson Institute suggest that a 10% or 15% across the board tariff would get you on the order of 1.5% of GDP a year in revenue, which is real money. It's still only a fraction of what lengthening and restoring the previous 2017 tax cuts would do, let alone the other things President Trump talked about in terms of tax cuts. Those start at $4 trillion and go upwards from there in 10-year costs, but it would be a meaningful number. If they legislate it, they get to count the number. If they don't legislate it, they don't officially get to count the number, though they'll claim the revenues, because then there's always a chance it could go away over the 10-year window. The flip side of this, though, is if you do the 20% tariff, 15%, 10%, whatever it is, if it's across-the-board legislation, then Trump doesn't get to do the bilateral bargaining and negotiating he's doing right now. Now, in theory, of course, they could put on the 10% across-the-board tariff and then on top of that, threaten additional tariffs. But I think that would be, in addition to harmful, would be unwise in terms of the inflationary impact from a political perspective.
So this comes down to global positioning as the absolute power in this intervening period between now and the potential, as you say, for legislating the tax. So this is about posturing, global posturing of the second Trump administration.
And I mean, every time you do a government action, you generally have a half dozen reasons why you do it. And so I think you're right, Menace, that's the main purpose. And like you said, splendid isolationism, Fortress America, whatever they're going for is clearly in that direction. But additionally, they want to show domestically that they're willing to beat up on Mexico. They want to show the world that they're willing to rescind a trade deal like USMCA that Trump himself negotiated. They want to put fear into Europe, which isn't quite posturing. There's some reality behind it. And I fear that they want to establish, just as they're doing on many other fronts as a tactical matter, some amount of numbness or normalcy around this kind of attacking allies. And that is, I think, again, harmful and ill-advised.
Adam, time is always ticking down on these meetings. I know that you're a believer in hikes later in the year. Briefly, before I move on to the weaponization of this, are you even more convinced now of the propensity for hikes?
On balance, a little bit more convinced, and we've seen now a couple members of the FOMC start to say they're worried about the inflationary aspect of this. The only reason, and so I remain pretty darn confident in my call that by September the Fed will be hiking, but there is an offset, which is if Trump does do what I've called overdoing it in the short term on tariffs, or for that matter on migration, he could cause a recession quickly, in which case the Fed then has no choice but to cut. And so I do think there's a risk, not so much from the tariffs per se, but if they do this across the board tariff, it's a major shock to real income for low-income families. It's a real change in who pays taxes, and that could cause a consumer-led recession. But I still think they're probably going to hike.
Yeah, well, there already is a blue-collar recession. The ability to take price rises from the shops is more limited. Let's close with a much broader concept, and I bring this to you from Mohamed El-Arian on his LinkedIn post yesterday. Adam, let me just read it to you in context. The weaponization of trade promises immediate gains for the U.S., but sustained over time, it risks eroding America's central position in the global economy and encouraging other countries to look for alternative systems it can bypass. I don't think this is a 2025 story. I don't think this is the next 4-year story. But I think Mohammed has a point here, which is the more that these are wielded around, the higher the risk is of a serious recalibration of capital and a real challenge to exceptionalism.
I think that Mohammed has a point that a lot of people are making, and I think it's wise. I think it's a little too flowery, and there are things that are going to happen over the next couple of years. As we saw with the auto industry cratering in UK after Brexit, we're going to see something similar in the US, that basically you will get some industrial inflows for people producing just for the US market. And trade will grow increasingly outside the US and outside to some degree China. And so you'll have Europe, Southeast Asia trade, Southeast Asia, Latin America trade, and you have a US that exports basically nothing in the manufacturing sector because it's going to become increasingly uncompetitive despite the energy subsidies. And those facts will take place in relatively short time if the Trump sustains this program. And before the sort of systemic cosmic stuff. I would also suggest that trade, and this is consistent with what Mohammed and others are saying, that trade is actually less vulnerable than movements in capital and movements in people and standards. And one thing I've been emphasizing the last couple of years is if the US, as it started to under Biden, but much worse if Trump pursues this policy mix, shuts itself out of all international fora, then the power that goes with being the standard setter, whether that's about intellectual property, whether that's about specific technical needs, whether that's about export controls, starts to erode.
Yeah, I mean, this is about the challenge to the exorbitant privilege, and we've already heard the president challenge the BRICS in terms of, you make any moves and you will do it at your peril. I want to qualify a couple of things that we've talked about. How quickly could we pivot from this exuberance that we have at the moment to the risk, and I understand it's a tail risk, of recession if President Trump goes over his skis, so to speak, in terms of aggressive policy, trade policy?
I wouldn't put it as a tail risk. I'd put it as 25% and possibly rising. And so it's a minority risk, but it's not just a tail risk. And that could happen quite quickly. If the risk comes from the change in tax incidence and fiscal policy and not directly from the tariffs, then it's probably 3 to 6 months away because it's going to take 2 to 3 months more to get the budget through and then for a while for people to believe it and feel it. And initially there'll be exuberance probably in the markets because the change in tax incidence will be seen as positive for profits. So I think it's a 6-month horizon, but once it turns, it'll turn.
Okay. As you say, you've brought it up from the tail to 25%. I was being generous. Adam, thank you very much. Adam Posen there of the Peterson Institute for International Economics with us this morning. Other stories trending on your Bloomberg terminal. This is what we've got. The Treasury Department accused of breaking federal law by giving Elon Musk's Doge team access to a trove of personal and financial information. The White House confirmed that Elon Musk is a special government employee and has abided by all applicable federal laws in his role. President Trump signed an executive action directing officials to create a sovereign wealth fund for the United States. Treasury Secretary Scott Bessent and the Commerce nominee Howard Lutnick would spearhead that effort. The fund would be created within the next 12 months and could be used to facilitate the sale of TikTok. UBS is aiming to buy back $3 billion of its own shares this year. It plans to repurchase $1 billion worth of its own shares in the first half of 2025, an additional $2 billion in the back half. CEO Sergio Motti spoke to Bloomberg earlier.
We are well prepared in terms of what it means for us in terms of risk management or capital management. That's the reason why we run a balance sheet for all seasons. But eventually, a bank is potentially going to be affected by second-order effects. What does it mean to the economy, and in turn, what it means to our clients?
Coming up, an exclusive interview with the Barrick Gold CEO from mining conference in South Africa.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famed, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg Brief. I'm Manus Cranny in New York. Let's get to Cape Town now, where the leaders in the mining industry are gathered for a conference at Indaba. Bloomberg's chief Africa correspondent, Jen Zabazaja, is sitting down with the Barrick Gold CEO, Mark Bristow, for an exclusive conversation. Jen.
Yeah, Manus, good morning to you. As you did say, we are here with a number of mining executives, and I'm here with Mark Bristow, the CEO of Barrick Gold. Mark, great to get you on set. So I wanted to start first with what we're seeing globally and the effect that it's having on gold prices. Record upon record upon record. What's your outlook for where bullion goes from here?
You know, as you say, Jennifer, everyone's trying very hard to push the gold price up. You know, what we're seeing is, you know, continuation of de-dollarization, fueled by the actions coming out of Washington and the White House, and on top of that, you know, we've got challenges in the UK. Europe is not in a good place with the French and the Germans, you know, the leaders of the free world, all in a crisis, and of course Middle East and conflicts in every continent. So, you know. Gold price has got a lot of upside still. I always say the risk is on the upside, and it's very much intact, that trend.
How much further do you think it has to go? Because some people believe potentially we've peaked.
You know, everyone has been saying that. You've seen the equities have been softer than the actual bullion price over 2024, but I don't think so. And certainly, I mean, there's a lot of reason why the gold price shouldn't go down. And
why?
And because it's when you try and if you try and look at what it's going to take for us to get back to normality in the global economy today, it's not an easy task. And I think we've seen, you know, damage to the US dollar as a reputational currency, and gold has taken that place. And I think what we've also seen, and a lot of people, because I'm sure it's your next question, you know, Bitcoins and all those are not stores of value. They are trading instruments. So gold has really arrived as the ultimate store of value, and people are buying the physical. What we've got to do in the mining industry is catch up with the price of gold.
Well, and I want to talk about some of the trends that we're seeing in the mining industry, one of which being M&A. We've seen a lot of that potential activity at least starting to happen. Is your expectation that that will hopefully, you know, strengthen the mining industry and get to some of those goals that you're just mentioning there?
So M&A really, you know, we need consolidation rather than M&A, because we've got too many companies running too fewer assets.
Right.
And so you need to consolidate, whether it's in the middle, mid-tier, bottom tier, or the big players. But I think what it's really telling us is, as an industry, we haven't invested in our future, and we're now seeing what we saw back in the early teens of this century, in that we're chasing growth, inverted commas, through acquisition, and we're paying big premiums for them.
Right.
And you know, higher gold price makes it look good for a moment, but things normalize.
What does that mean for Barrick's assets then, and especially on the African continent?
All the assets are very valuable. Whatever assets you got, particularly if you're in gold and copper today.
Right. So you're not planning to exit any of the operations?
Definitely not.
Okay.
No, we constantly look at our core assets, because I'm very focused on high quality tier 1 assets. And so there's a market for those non-core assets, but we're a long-term player. We invest heavily in growth, organic growth. We are pointing to a 30% increase in production by the end of this decade, organic growth
at all of your operations
across the group, and that's going to happen without any issuing of shares. In fact, we're buying back shares. So
when are you going to start buying back shares?
We have already started.
Do you plan to continue doing that then?
Absolutely. Certainly where the share price is sitting at the moment, one of the best investments we can make is buy back our own shares.
What do you think, where do you think the share price then has to go?
I think it's got to go up.
Okay, yes, but then what is your goals then for that?
I think, that's the market will judge that, and at the end of the day, what we've got, and we're about to bring out our 2024 results, we have one of the strongest balance sheets in the industry. We were able to buy back our shares, and we're investing all the time in new opportunities. And more importantly, we're about to build out 2 really big mining projects, the expansion in Zambia, doubling production, and then the big gold and copper asset in Pakistan, which is one of the biggest gold and copper mines that haven't been developed yet in the world.
And Mark, I also want to talk to you about another one of your operations that's in Mali. There's been a lot of focus on what's happening, the discussions between the Malian government and also Barrick. What is the next shoe to drop? Where are we at right now in negotiations?
Jennifer, it's been a very sad time for me. I've been in Mali since it was really re-established as a democracy, and I've worked with all the governments since 1992, and I think Mali's got itself in a position where it's really trying to shake out some short-term cash out of the industry, and this industry is the very foundation of its economy. And I think we need to, and so communication, to your point, is really important. Right. We are in communication. We are working we're making progress, not as fast as I would expect it, but I'm sure everyone is a little cautious because that's what happens when you get on the wrong side of everyone.
So you haven't agreed to a number or to paying back any of what?
No, we haven't reached an agreement on anything yet, but we are making progress, and I think that's the positive of these engagements.
Thank you so much. We have to leave it there. Mark Bristow, the CEO of Barrick Gold, joining us here at Africa Mining in Daba. Manus, back to you.
Jen, thank you very much. Great conversation there with Mark, stalwart of the mining industry. In Cape Town, let's take a look at the rest of the day. You have got a little bit of data. JOLTS data hits the tape at 10 a.m. Eastern time. And then we count down. There's a plethora of Fed speak. Bostic, Daly, and Jefferson through the day. Let's see what they perhaps say about the risk of tariffs. The Israeli Prime Minister Benjamin Netanyahu will meet President Trump at the White House later today. But there's really only one gleaming stock that we're focused on at this pre-market. Palantir extending their double-digit surge, I should say, after the CEO talked about untamed AI demand on the back of their strong results. So that's up just under 20%. The surveillance team will take you through the next couple of hours, talking about tariffs and the risks to markets on Bloomberg.
To succeed in Wall Street,
yeah.
What skills do you need? You need to be somebody that claws people on the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Doesn't look to me like Wall Street has priced in these tariffs going into effect on a sustained basis.
I feel like the risks are much higher than people appreciate.
The biggest theme is risk off.
You think we're at the beginning of a multi-year move out of the U.S. into non-U.S.
There's so many unknowns. Our approach is, you know what, we expect nothing, but we plan for everything.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, feeling like it's already Friday. Equity futures on the S&P 500, negative. We're down across the board, just slightly. We're off by 0.2% on the S&P. On a Russell, the small caps, we're down by 0.1%. What is the price to pay for all of this uncertainty? Diageo in the UK removing its sales growth target. The why? Tariffs. GM put out guidance only last week, an outlook that very few believed in. The Bank of Canada, this is hurting central banks too, basically provide no guidance whatsoever. And then Fed officials, they struggle to even discuss the tariff story. There's a sense that for some of these officials, these policymakers, there's a sense of paralysis.
Because they don't understand exactly what the ramifications will be and exactly what the policies will be. There might be a tone of, we're telling you exactly what they are, and yet the whipsaw action that we saw yesterday of the threat of them going into effect, those tariffs at 12:01 a.m., and then being removed, kicked down the road until March 4th with both Canada and Mexico because of certain provisions that already were going into effect. It just leaves people with a lack of understanding of what the benchmark is for success and how exactly we get there.
So the last couple of weeks, and it's been a busy few weeks, so threats on Colombia, they back off, they provide concessions. Threats on Panama, they back off, they provide concessions. Threats on Canada and Mexico, they back off, they provide concessions. Is it different when it comes to China and Europe? That's got to be part of the conversation that we have this morning. Academy's Peter Chibb put this out in the last 24 hours. We're only just beginning with China and Europe. Maybe Colombia and Mexico set the precedent. Inflict pain, get a deal, move on. He says, I'm increasingly dubious on that front.
It matters exactly how this president is going about trying to inflict tariffs and why Mexico and Canada were first. It was because fentanyl and border security was an easier way to try to go for emergency powers and go after these concessions. It also was to get some quick wins before the harder, more entrenched battles begin. The reason why people are having a hard time coming out with outlooks is how do you even game this out when people still don't understand whether this is over, whether March 4th is going to be yet another kind of paralysis moment where they're kicking down the road to another month. people don't have an understanding of what the framework is that Trump is even negotiating with.
So how much data and earnings and Fed speak will change anything for you? How much can they actually provide about the outlook? Today we get jolts. Get that at 10 a.m. Eastern time. We'll get some factory goods orders as well, so look out for that. You'll get some Fed speak too. You'll hear from the Vice Chair, Philip Jefferson, later on today, so look out for that as well. And then after the market, you'll get Alphabet earnings. Does any of this make a difference, given the bigger challenge that we face at the moment?
It's a good question. Fed speak, I don't think, makes a difference right now. Unless they're willing to raise rates in response to the tariffs, they're paralyzed as well. And a lot of people say that's fine, including the president. So you can put the political discussion on the back burner. Alphabet's earnings, I think, are going to be very interesting. They are coming under attack of China, although it's a little bit of a false pretense because they haven't been operational in China since 2010, but they're being investigated. When you listen to some of these earnings, how are they trying to immunize themselves from trade wars, moving production back here or not? Are they pulling back on some of their investments? Is this leading to a lack of business confidence? These are some of the questions I want to hear. And with jolts, the economy still matters. It matters whether the economy is sinking or whether it is growing, and that sets the backdrop for just how much this president can do.
If you're just joining us, welcome to the program. Equity futures down slightly, just building on yesterday's losses. Only recovered so much in yesterday's session. Equity futures down by 0.1%. Coming up this hour, we'll catch up with Steve Chevron of Federated as China hits back, kinda. Dan Ives of Wedbush saying automakers can weather the storm, and Francis Donald of RBC on the economic impacts of a trade war. We begin this hour with stocks steady following China's restrained response to US tariffs. Joining us from Washington, D.C. is Bloomberg's Anne-Marie. AMH, what a 24 hours to kick off this week.
Absolutely, a 24 hours. So when it comes to Canada, Mexico, that trade war is now really just trade tensions. You're seeing Donald Trump put on pause for 30 days. Those tariffs, he only just talked about over the weekend, and they were planned to go into place just after midnight. Well, they were clawed back after those phone calls with both those countries' leaders. You see both those countries saying they are going to do more to protect the borders and stem the flow of fentanyl. We should know some of that was already announced, especially when it came to Canada and having a more robust approach on the border in December. But clearly there was a conversation there that they are going to look more into this, and that was enough to appease the president to claw back these tariffs and wait 30 days. So now there's a new deadline in early March. When it comes to China, there's a little bit of a different story. We are seeing the start of a trade war. Yes, China's response was very calibrated, but it was going after specifics that I'm sure will get the president's attention. Things like energy. He wants to be an energy mass producer and exporter. Also, I would note export controls on critical minerals that are used in the defense space, that are used in the manufacturing space when it comes to clean energy materials, things like tungsten. They were calibrated, but certainly to get his attention. Now, China did say those will not go into effect until February 10th. That's next week. And we did hear from the president yesterday, and he said he was planning to talk to China in the next 24 hours. And his press secretary says, yes, he plans to speak to Xi Jinping. So that's the next phone call to watch.
Anne-Marie, the question yesterday, how long would all of this last? For Mexico and Canada, not very long. The question this morning, who's next? And is it Europe? And what do they need to confront in the weeks and months ahead?
Well, with Europe, it's going to be incredibly challenging, especially seeing what the United States is doing when it comes to this tit for tat so far we've seen in the past 24 hours with China. Just look at something like crude oil or LNG. If China's putting a tariff on that, potentially some of those cargoes will not go to China, but Europe can take them. But then China might have to dump some of those more materials of things that they're facing tariffs on Europe. So Europe really is going to be potentially the dumping ground in the middle of this trade war. And they're going to get caught in the crosshairs. And yet, Donald Trump is still saying Europe will be next. We don't have a timeline yet, but it is certainly on the horizon. He complained yet again, a long list of grievances when it comes to Europe, especially when it comes to things like auto manufacturing. It really bothers the president. Angela Merkel talked about this in her biography, that, you know, you look around Germany, there's a lot of Mercedes, a lot of BMWs, same in New York City, not a lot of Fords.
Anne-Marie, appreciate it. AMH down in Washington, D.C. Can we save that for next Monday? Can we do the European story then?
I mean, we'll see. We'll see what happens. To that point, there's a 10% tariff on all U.S. cars going into Europe, and there's a 2.5% tariff that the U.S. slaps on some of those BMWs and Mercedes. Maybe we could talk about that next month.
And then the truck one is slightly more confusing.
Exactly.
It's an even bigger one on the trucks coming into the United States.
Yeah, so it's a little bit difficult to sort of square, and I'm sure we'll be discussing it ad nauseum.
Trade is complex, that's for sure. Steve Chevron of Federated saying this, warning not to get distracted by the noise. We need to see how this plays out. The key is to remain focused on economic fundamentals, which are positive, and the sum total of policy changes, which are also likely to be positive. Steve joins us now for more. Steve, I'm pleased you put in that last line, the sum total of policy changes. Can you talk about the trade effort without talking about the tax effort that's still to come?
No, and I think that the timing of them is positive, right? I'd much rather be talking about the sticks today and the carrots tomorrow than the other way around. In other words, we're clearly engaging in a trade negotiation dance. I would not call it a trade war at this point. I think clearly the president's focused on the Western Hemisphere and getting concessions there and building up, if you will, to this main event negotiation with China. But I'd rather get that out of the way early in the administration, let the market go through this period of digestion, and then look forward to tax cuts, deregulation to come. I think that's going to set us up for a much better second half, strictly from a market perspective. So I think you really do need to look at both of those, John.
This is a really important point, Steve, and John opened the show saying that the uncertainty from yesterday has remained, and you could see that in the equity price, which end of the day down despite some of the reversal of some of the tariffs. If you call it a trade negotiation dance that could end by mid-year, what's the statute of limitations? How long could this sort of back and forth go before suddenly it becomes a fundamental headwind to your positive view?
Probably not supposed to say this when you're a talking head on a television, but nobody knows, Lisa, right? I mean, clearly the United States is the economic power of the world, and it's the buyer of the world, and this president recognizes that, and he intends to use that leverage point in a way that we really haven't had a president, in any of our investing lifetimes, use that tool. He's threatening to be less of a buyer unless he can get concessions on a range of things, from national security to economic relationships to access to certain materials. And if anybody can say, well, this is exactly how it's going to play out, you're making it up. What I do think is clear about this president this time around is nothing that he's doing is random. He had 4 years to sit and stew and think, what would he do if he had the reins of power? And there's no apparent look here like he just wants to inflict tariffs for the sake of it. It looks as though he has very specific policy outcomes that he's trying to drive. And to overreact to the dance, I think, is just going to hurt portfolios rather than being calm, focusing on the fundamentals and seeing how all this plays out. So as much as we want to know the answer, we've got to go through the dance.
Is it overreacting to the dance to sell GM shares?
Well, I mean, look, I'm not going to go into positions that individual funds hold or not, but I do think, more broadly, Lisa, the way you have to think about this is, do you have a business that's growing? Do you have earnings that you think are of high quality? And yeah, I mean, look, do you want to focus on companies that maybe have a little bit less tariff risk? If you're thinking about a short-term perspective, fine, do that. If you think, however, that the outcome of the tariffs is going to be a world that is maybe a little bit more friendly to U.S. automakers, or you're going to have a more fair playing field, then you should look for weaknesses as opportunities. It depends on your time frame. What I can tell you from our perspective at Federated Hermes as a kind of longer term investor is when we see dislocations around things like, healthcare stocks freaking out about RFK, or stocks overreacting to tariff news, or even some of the hysteria last week around AI, we certainly start to look at those areas and say, is this an opportunity to buy at a discount? And I expect we'll make some of those moves over the coming weeks.
You were very measured about it last Monday, and then we had another Monday shock to deal with, Steve. We can stay big picture
like this, John. We got to stop meeting.
I know. I was saying we'll do Europe next Monday, so come back on next Monday. Let's hope they wait for that. Steve, bigger picture, if we can stay there. Do you see a policy mix that attracts capital or pushes it away? We had a guest on yesterday, Jay Pilowski, certainly a contrarian, who was making the argument that he sees enough policy chaos here that pushes capital away from the United States, doesn't draw it in. What's the biggest pushback against that call?
Yeah, I think in the short run, everybody, and Lisa, I think hit this perfectly a second ago. Everyone is in a little bit of a wait and see mode. The Fed's in a wait and see mode. The market's in a wait and see mode. For all of the noise yesterday, what did we muster? 1.5% down at the worst? We've killed AI and started a trade war, and we're still above 6,000. So I think everybody is actually doing a pretty good job at taking a deep breath. I expect in the short run, businesses are going to want to be cautious. I think earnings guidance is going to be cautious. I think investment decisions may be a little cautious. I do think, however, that if at the end of this, the president's achieving some of his policy goals, if he pushes and uses tariffs to push Europe to spend a little bit more on defense, maybe kind of end the conflict in Ukraine, maybe be a little bit fairer on certain trade elements if you secure the border and or have less fentanyl coming into the country. I think on the other side of that, especially with deregulation and lower taxes, you're going to create a more favorable investment environment. And so I think we just need to get through, we talked, a couple of weeks ago about this sausage making process. There's going to be negotiations on policy. There's going to be negotiations on rejiggering these trade relationships. But I do think on the other side of it, you're going to get an environment that is attractive for investment. And as an investor in public markets, you need to look for those opportunities where you get prices that become discounted as you're going through that adjustment process.
So, Steve, let's end there. What do you like right now, with all of that in mind, all the dislocations we have seen? And to your point, we have been through a lot, but we haven't done a lot. The S&P 500 is still around 6K. Have those dislocations, those opportunities opened up, or do you still wait?
I think you still wait. It's a 3% pullback at this point. And so, we would look for maybe a little bit more weakness in the markets, but I think we would likely be buyers of that. What we have seen from a stock market perspective, each of the last 2 Mondays, is a quality trade, right? And it's again, like it has been in the last couple of instances, it's a barbell trade. It's good quality growth companies that are generating their own earnings growth, their own story. You saw Palantir last night and the reaction that it's had. But it's also some of the traditional defensives. Look at the tape the last couple of Mondays, things like consumer staples, things like healthcare, things that are less impacted by some of the trade noise, but are good quality, stable earners. And let's not forget that behind all this, earnings are growing 11% on a year-over-year basis. It's really one of the best quarters we've had in the last 3 years, and guidance has been pretty good. So I think it's a stock-by-stock game, but it's the traditional defensives, and it's also some of these growthier defensives.
Hey, Steve, appreciate it. It's good to see you. We'll see you on Monday 10th. Okay, Steve Chevron of Federated on the latest. Quite a few Mondays that we've seen. Credit to Bank of America at Goldman Sachs for the 2 economist teams out there who basically said this would be short-lived. And I think cooler heads so far have prevailed. We talked about this yesterday. If you really thought we were going to get 25% tariffs on Mexico and Canada, the S&P's not down 2%. GM's not down 13% in 5 days. It's down more like 30, isn't it?
It seems as though the people with the hotter heads are in the currency market and they are trading quick. And the people in particularly the stock market are looking at the fundamentals and saying it's not going to move the needle that much. You mentioned Diageo, though, and it was a right call to mention that. Withdrawing guidance, how many more of those do you hear? Does that begin to actually show a toll if we don't get some more certainty in the next few weeks and months?
How can they offer any outlook on sales into the US when half of those sales are coming from some of the countries that we were talking about, Mexico and Canada, facing the prospect of 25% tariffs? To your point on FX, the range that we saw in foreign exchange just yesterday, dollar mex, 3% to the upside and down 2% plus to the downside. 5 percentage point plus swings on dollar mex is kind of unreal.
Same kind of moves in the Canadian loonie as well. And just want to point this out, the swings in sentiment are also going further than the currency market. Did you see Canadians booed the United States at the hockey game?
I know.
I mean, there's a definite visceral reaction. Does that go away, or do these kind of entrenched hurt feelings really, become pervasive between our neighbor and us?
I hope that goes away. Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Hacker. Say, Yahara.
Hi, John. China is retaliating against President Donald Trump's tariffs. Beijing imposed a 15% tariff on less than $5 billion of U.S. energy imports and a 10% fee on American oil and agricultural equipment. The Chinese tariffs are set to kick in February 10th, possibly leaving room for negotiation. Meanwhile, President Trump signed an executive order to create a sovereign wealth fund for the U.S. The president says Treasury Secretary Scott Bessent and Howard Lutnick, his nominee for Commerce Secretary, will spearhead the effort. The action calls for them to submit a plan within 90 days with details on funding, investment strategies, and governance. And let's take a look at Palantir shares. Those are up nearly 20% in the pre-market. The company reporting a 36% jump in fourth quarter revenue and forecasting full-year growth that beat analyst estimates. The company's CEO attributing the results to untamed organic growth in demand for its AI software. That's your Bloomberg Brief. John?
Yahara, thank you. If there's a phrase that I'd ever want to use as a CEO, it's that one right there. We're seeing untamed organic growth. This stock was up more than 340% in 24.
The superlatives that AI lends itself to, and we heard the same type of superlatives that Elon Musk used for some of the robo-taxis, speaks to the moment.
That stock is up big in early trading. Up next on the program, China hits back.
We'll be speaking to China probably over the next 24 hours. China's involved with the Panama Canal. They won't be for long. And that's the way it has to be. If we can't make a deal with China, then the tariffs will be very, very substantial.
That conversation is up next, live from New York City this morning. Good morning.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
So here's the setup this Tuesday morning, and good morning to you. We're negative by 0.2% on the S&P 500. Over in the bond market, yields are higher by a few basis points. We're up 2 on a 10-year to 457.33. Under surveillance this morning, China hitting back.
We'll be speaking to China probably over the next 24 hours. China's involved with the Panama Canal. They won't be for long. And that's the way it has to be. If we can't make a deal with China, then the tariffs will be very, very substantial. Nobody can compete with us because we're the pot of gold. But if we don't keep winning and keep doing well, we won't be the pot of gold, and then tariffs won't be so good for us.
So here's the latest this morning. China retaliating against President Donald Trump's tariffs with levies on some U.S. goods. Beijing imposing a 15% tariff on less than $5 billion of U.S. energy imports and a 10% fee on American crude and agriculture equipment. Team coverage starts right now. Bloomberg's Ollie Crook joins us in Hamburg, Derek Decluet of Toronto, and Creighton Harrison joined us in Mexico. To the three of you, thank you, gents, for being with us. Ollie, I want to come to you first. We are told Europe is next. What is Europe doing to prepare for that?
Yeah, listen, the sort of the tactic that Europe has had for the last couple of months is to say very, very little, to say nothing negative about Donald Trump, to take a very sort of optimistic approach towards things and really sort of hope for the best and really hope that the sort of tariffs would be sort of worked out ahead of time and potentially would never come into effect. Again, what we've seen in the last sort of 24, 48 hours may to some degree reassure the Europeans, though on the other hand, it is also saying that Trump does mean business. And when he talks about 10% tariffs on European goods towards the EU, you know, that is a very substantial part of the economy here. I mean, the estimates sort of range. It could be 1 percentage point of growth off of GDP. But again, what's also interesting is that the EU does not work like a country, like Mexico, like Canada. What are the things that he's going to want to extract out of the European nations? It's probably going to be more spending, as he has said in the past, on LNG, fossil fuels, that sort of thing. That's a fairly easy box to tick for the Europeans because they already are in need of that, and potentially these tariffs from the Chinese side could help get them at a better price. And also is the question of NATO spending, right? We have heard it many times from Donald Trump. 5% is what he wants to see at NATO. Again, all of the Europeans say they want to spend more. If they're willing to hit 5%, it's potentially a different story. What I think is interesting, John, and I think it's highlighted also by what we saw in the retaliatory action from China, is that for Trump and for this world, this may not be distinct trade and sort of, for example, antitrust issues. All of this stuff could be bundled up, and that will really concern the Europeans.
Meanwhile, Derek, over in Canada, they have responded with some measures that include a fentanyl czar and a new U.S.-Canada joint strike force. Do we have a sense of whether that will be enough to push the can down the March 4th deadline to beyond that and really get some sort of trade agreement in place?
I don't think there's a tremendous amount of optimism yet in Ottawa that this is anything like a permanent solution. I mean, as you said, there are border security measures, some of which the Canadian government had already announced, and then they added a few yesterday, like the fentanyl czar, like agreeing to name cartels as terrorists. But Trump was clear in his Truth Social post that it's 30 days to then work out an economic deal with Canada, and nobody's quite sure yet what that means. The U.S. does have a trade deficit with Canada. Trump has mentioned that many, many times, and so obviously there will be a further negotiation, and in 30 days, who knows, but nobody thinks this is much more than a temporary reprieve up here.
In Mexico, Creighton, the temporary reprieve is 10,000 soldiers to the being sent to the U.S. border. That is among the different provisions that Mexico has put on the table. What more is necessary? Do we have a sense of that?
Well, if you take at face value that what President Trump wants is border security and reduction of fentanyl across the border, then the other important thing that came out of the call between Sheinbaum and President Trump yesterday was this idea of creating these working groups of cabinet-level officials, so, Secretary of State in the U.S., the foreign minister in Mexico, et cetera, they're supposed to be meeting regularly to sort of work through these issues and try to find solutions. Will they solve migration and fentanyl in 30 days? Probably not, but if they can get enough momentum going through those connections, then the president in Mexico, President Sheinbaum, is hoping that will be enough to convince President Trump to move on from this.
We've got another deadline. To Derek, to Creighton, to Ollie, to the three of you, thank you. Appreciate it. Just to stay on Mexico, $MEX is basically back to where it was on Friday at the close. Some big swings.
That has been the area of action, and it could go the other way, but right now people are saying at least the temperature has been lowered.
Up next, we'll raise the temperature. We'll talk about big tech with Dan Ives of Wedbush on the impact of tariffs on the automakers. That conversation up next.
Do you think it'll be the case where someday you would be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Just a little sense of calm, at least for now. Equity futures down by 0.1%, just about unchanged on the Nasdaq. Had a lot of Fed speak in the last 24 hours. The Boston Fed President Susan Collins saying there's no urgency for making additional adjustments. We heard from the Fed President over at Atlanta, Raphael Bostic, also saying depending on what the data is, it might mean that we are waiting a while. This Fed's not in a rush. So check out the bond market, 2-year, 10-year, 30-year. Interesting moves yesterday, not so much at the front end of the curve, yields were higher, but at the longer end of the curve, where yields were lower. And I think if you asked a lot of people in fixed income, off the back of the tariff threat, they might have been focused on the inflationary component of it, an inflationary outcome and the prospect of higher yields. This is what BMO's Ian Lingen had to say on yesterday's move. For what appears to be the first time since Trump's election win, the market is looking beyond the near-term inflationary impulse of tariffs and is beginning to contemplate the impact on global growth. That's a change.
At a time when you have every former Fed official and current Fed official saying it has in the past been disinflationary and actually a growth shock. We heard that from Jim Bullard, the former St. Louis Fed president. I will say, though, 10-year yields didn't go down as much as people expected, given that equities were selling off. So hard to interpret what this move really means at a time where there was a lot of volatility yesterday.
And a lot of volatility right here too in foreign exchange. So let's turn the page and get to the FX story. A snapshot of things currently, and I just want to focus on euro dollar. The euro's negative by 0.2%, 103.23. Europe has escaped nothing so far. The prospect of tariffs still lingers and still looms large. This is what Nomura have to say. We see a move towards parity as likely over the next few months. Weak macro and ECB policy easing risks remain in place. It's not just about the tariffs, it's about the outlook for the continent.
At a time when you saw the inflation read yesterday come in hotter than expected, even though this is really inconvenient for the wish to really lower rates, Europe's in a tough spot. Everybody knows this. Yet that was the best performer last month. And the reason why was because people figured the bar was so low, any news would be good news, including the fact that we hadn't heard about tariffs. Well, do we see a reversal of that now?
Euro Stoxx 50 up 8%. Almost 8% in January. Unreal. Euro dollar right now, 103.23. Under surveillance this morning, China hitting back against President Donald Trump's tariffs, imposing a 15% tariff on just under $5 billion of U.S. energy imports and a 10% fee on oil and agricultural equipment. Analysts calling the retaliation restrained, with the measures set to kick in on February 10th. Keep saying China's hitting back. This is not a punch. This is like a little pinch, if that.
I love that they're investigating Google, even though Google hasn't operated in the country since 2010. Ooh, they're scared. They're also going after, the parent company of a couple retail companies. The big issue is actually the key mineral supply chain. Talking about potential export restrictions. All of this is basically saying, look, we can do this. We can have a significant measure. This is a negotiation. They're supposed to talk in the next 24 hours. Let's see what they have.
Don't you sense it's a different negotiation, though? That China is somehow different to what we've just seen with Mexico and Canada in the last 24 hours?
There is bipartisan support for increasing some of the distance between China and the U.S. There are multifaceted aspects of this. When it comes to fentanyl, when it comes to national security, There are a lot of other questions with China, and we're going to see those untangled. It is a very different discussion than Mexico and Canada. It is getting the ball rolling in a multi-stage process where it might be different with Mexico and Canada.
Which bucket do you think Europe is in right now, one or the other? Trump's tariff threats driving a bit of a wedge between the EU and United Kingdom. European leaders preparing for possible tariffs after Trump reiterated a warning to the EU that they will definitely happen. This coming as Trump said the UK would probably be spared for now. Some rare good news for the United Kingdom.
Okay, maybe. I mean, there is this issue of do they have to choose between the U.S. and the European Union? They have an advantage, as you pointed out yesterday, of Brexit. They can say, look, we're independent. We're not part of the continent, so don't look at us. And by the way, the U.S. actually has a trade surplus with the United Kingdom. Very different scenario. That said, a lot of things could change. And the truth is, they're facing a lot of negative growth shocks, potentially, at a time where they have to put some sort of olive branch out to the European Union. So it becomes a very difficult moment for them.
I do think there's a lesson to come from my home country, though. How badly they managed the PR when they came into power. And I'm talking about the Labour Party and the Labour government coming out and really talking down the economy, talking down the public finances, talking down pretty much everything across that nation, and then saying, a few months later, we're pro-growth and we want to do all these good things. And I think if you're a business right now or a consumer, you're still scarred by the communication you got a number of months ago. And I think there's a lesson here for the United States as well. Confidence is sky high for this administration to deliver a pro-growth platform. And we've had the sort of like anti-negative growth stuff up front. It's hard to put the toothpaste back in a tube. Don't sacrifice this confidence. We want to see that confidence translate into investment decisions, translate into hiring decisions. And I think right now you're denting some of that confidence with the action of the past few weeks. Whether you think it's the right action or not, there are consequences.
That's the reason why earnings calls are going to be that much more interesting. How much do people withdraw guidance? How much do people postpone some of those investments? How much do people say, well, we can't make big hiring plans because we don't have a sense of what that framework looks like? That's what really is going to tell whether there is a real lack of confidence.
We get some earnings a little bit later. We get those earnings from Alphabet, set to report fourth quarter earnings after the closing bell. Analysts expecting the company to deliver solid growth with its cloud computing and search business very much in the spotlight. We learned a little bit over the last week. We heard from Microsoft, we heard from Meta. We should have a decent read on what we should get from Alphabet.
Capacity is going to be important, given that that was the sticking point for Microsoft. They didn't have enough capacity to meet the demand. Does Google? Are they actually growing share in the cloud computing services when they are number 3 based on AWS and Azure? So these are some of the questions. Also curious to see what they say about China. Hey, we don't work there anyway, so it doesn't really matter to us.
Don't know what they're talking about. Don't know what are they talking about. Let's turn to the auto industry. Dan Ives of Wedbush is not overly concerned about tariffs, writing the supply chain can adjust to a near-term shock and weather the storm. If these tariffs stay in place for 30 to 60 days, we see minimal impact to GM and to Ford. Dan joins us now for more. Dan, good morning.
Great to be here.
30 days. If we got that in 30 days and they lasted 30 days, are we only saying there's only going to be like minimal damage? Does this not hold these companies back from making big decisions?
I think it's minimum. I mean, I'll be in Detroit, tomorrow. I think ultimately right now in terms of GM, Ford, it's very contained in terms of the impact. Now, I think when you look at Tesla, that's probably the one that's least impacted, especially given their supply chain. But our view is here, bark worse than the bite, whether it's on the auto side, and I continue to view on the China side, even on chips, even though that's pressuring names like NVIDIA and others. Just as we've navigated in 2018, 2019, you don't sell these stocks because of it, because I continue to view, just like you talk about, where's the spending? I think it's going to be another robust number from Google tonight. Saw Palantir and others. AI revolution alive and well. Tariffs are not impacting that in our view.
One of the reasons why your analysis is particularly special is not just because you've been right about a lot of it, but also you travel a lot. You talk to people. You see the sentiment. Has there been, even in the past couple days, any sort of shift in the optimism because of the uncertainty?
Yeah, I think less about in terms of Mexico and what we're seeing in Canada. It's from a China tariff perspective combined with DeepSeek. I think there was just general, maybe a little more agita in terms of what that means in terms of U.S.-China cold tech war, tariffs, what the next step is. Because part of the issue is, if you go back to this last week, Nadella doubles down $80 billion, Zuckerberg $65 billion. You see just massive CapEx tonight from Google, Palantir, and massive AI, just another phenomenal quarter. I think the worry is, could anything spoil the party? And the only thing that spoils the party is a ratcheting up in terms of U.S.-China tension. So I think in terms of the nervousness, that's why you're seeing pressure on NVIDIA, on overall tech here, as this plays out.
GM was supposed to be immune from this because they actually moved their operations and their business out of China largely to Mexico. Now they're in the crosshairs. I just wonder if other tech companies in particular are moving operations out of China more aggressively to immunize themselves from this type of shock.
Yeah, I mean, like, to that, look, in GM, it's been sort of one punch after another from the EV perspective in terms of from one administration to the other, the Mexico situation. But I do believe, Mary and the team navigated that extremely well. And I think GM continues to be a stock that we're bullish on here. In terms on the China side, look, my view, we talk about if Apple decided today, if Tim Cook's like, we're going to move 10% of our supply chain out of China, that would basically take about 2 years and ultimately something that could cost, what I think 30, 40 billion if it ultimately, translated. The point is that it's always easier said than done. And I think that's the conundrum, because the reality is, like, when you look at Apple, you look at Tesla, that's why Cook, Musk, 10% politician, 90% CEOs.
Let's talk about Elon Musk and the closeness to the administration. We've talked about the benefits of that closeness and what it could mean, the halo effect, as you've talked about, over Tesla. Foreign nations are starting to see this as a potential pressure point. We saw that from a Canadian province in the last 24 hours, threatening to cancel a Starlink contract. Is it a benefit or not?
There are definitely offsets, as we've talked about, but the gold at the end of the rainbow is autonomous. I mean, autonomous, we think that that's worth $1 trillion. In terms of that to the Tesla story, I think as you get a federal framework, and I think this is key in terms on the Trump administration, that's the path for growth in terms of what I view as generational growth for Tesla. So Musk, he's someone that's, he's not going to, ultimately peel back, right? So he's going to continue going in this direction. There's negatives, no doubt, but I just think the positives, it was a bet for the ages on Trump, and it continues to be that, and I think it's going to be a historical bet.
The president clearly wants to celebrate the national champions of American and corporate America, and so he should. So he should. Let's be clear about that. The question I'm asking is whether other countries begin to punish those national champions. We've seen that from the Europeans on tech. We've seen the tech players not even be able to get into China.